In Korea, Japan closed. The Chinese market not actually the area of weakness today. S&P futures up just 0.1%. I put that in because it's just faded a little. We were expecting a bit more of a bounce from Friday's session. Friday, as you say, Tom, dragged down by tech sentiment, also by sentiment surrounding the auto sector, even if the autos players themselves didn't necessarily move in line with that story. This is the Brent crude price, up another 0.9%. We're getting awfully close to $95 a barrel on Brent, so that's what markets might focus in on soon. And the euro at 106.60 just in the wake of the ECB last week, and as we move into a crucial week of rate decisions here in Europe. Tom, what do you see in futures?
Futures pointing lower by between 0.2 on the DAX and 0.4 on the CAC current, pointing lower by 31 points. It looks like we're set for a relatively down session.
Okay, so a down session then, at least at the start of the trading day, is the expectation. Futures suggesting we have a little bit more negativity to price in. As Tom was pointing out, a lot of that really Friday story from the United States, where we saw sentiment weighing on markets around the auto space and around technology shares. The Nasdaq was the area of most intense selling pressure. That has spread through into the Asia session then and is expected to come through into Europe, but also we are focusing our eyes on the future and all of the central bank decisions to come. The FTSE 100 then pretty flat, so pretty unmoved. The Spanish IBEX just down 0.1%. A lot of grey on the Forex column as well, so not seeing very many outsized moves. The Bloomberg Dollar Index pretty flat. We will hear from the Bank of England, of course. We'll also hear from the SNB. So the pound and the Swiss franc will both be in focus this week in terms of European central banks reporting. A mixed bag on sovereign credit. One thing we can be sure of, though, oil prices are going higher this morning, Tom, up by 0.8% on Brent crude, 94.72 right now. What do we see on sectors?
Despite that, the energy sector as a whole is currently down about 0.1%, despite, as you said, Brent getting close to that $95 a barrel level. The consumer sector is down by 0.5. This was the leading sector in the gains that we saw coming through from European equities on Friday. So pairing some of the gains that saw coming through at the end of the week. Autos is currently flat. That's also one of the biggest gainers on the Friday session. Basic resources gaining 0.2%. Media is taking a bit of a hit, down 0.6%. And a couple of other sectors standing out. Construction off by 0.2%, and utilities often a safe haven, but currently down around 0.2%. That's a shakeout across these sectors in the first minute or so of trading.
Okay, yeah, a slow start to a Monday. I know how they feel, but we are a positive on around a third of the sectors, I suppose, 2/3 in negative territory then at this early stage of the trading day. Now, it is a big week for central banks. The Fed will take centre stage with the FOMC rate decision on Wednesday. The BOE is in focus on Thursday, and the BOJ on Friday, of course. Eddie van der Veld joins us from the Markets Live team, and he can talk us through his thinking on central banks. Eddie, very good morning to you. So it's going to be a busy week for central bank decisions. The Fed, of course, looms large. What are you going to be looking out for then from these central banks?
Absolutely, Anna. It's a really big week, as you say. We're going to have this rush of meetings. The Fed is key, Japan is key, you know, the Bank of England's key, but we also have things like Zimbabwe and Egypt and Norway and Sweden. Not that I basket those together, but you know, we've got some really key and a whole host of them. Now, central banks have been raising rates. The rates are high. How high can they keep them there? That is the next question. And you know, I think they will want to say, hang on, we're going to keep the fight on inflation. I think, though, that the central bankers feel pretty good about themselves mostly right now. They're seeing inflation coming down. They feel like they've done most of the job, and they want to sit tight for a little bit. The question is whether the data is going to allow them to do so.
Well, on the data front, the PMIs then out later this week. How important do you think they'll be in terms of the guidance for the central banks, but also for the markets?
Yeah, because in many parts of the world, we're starting to see that stagflationary narrative coming through, right? We're seeing those PMI numbers particularly weak, particularly on the manufacturing side. And then, you know, services starting to dip into the red as well. And if you continue to see that, then it really undermines this idea that they can keep rates high for long. And you know, if they're going to have to start being forced into cutting at a time when inflation is still above target, that is not a good place for central bankers to be in.
We could really end with a bang, couldn't we, with those flash PMIs out of Europe, I'm thinking, on Friday. So just as we think it's nearly all over with the central banks, we will get that data, and that'll be a nice reminder, as you say, of some of the stagflationary forces, perhaps, if that's what we see. What about higher oil prices then, Eddie? Because Mark has been giving us his views over the last few days about, yes, watch commodities, watch higher oil prices, that can be inflationary, but he thinks actually it's going to have less of an impact on inflation and be more a downdraft on growth, actually, when we start to see some of this. But what are your thoughts around the higher oil prices? I mean, we go ever higher.
I mean, look, that's a really good and interesting view, but I do think we shouldn't forget just how important it is for the inflationary narrative, because I think, you know, the lower oil prices this year compared with a year ago has been a disinflationary force for much of the year so far. Now it's starting to move in the opposite direction. So a lot of the headline figures that we're seeing, you know, we're pricing those things out, and it's even going to feed into core, because, you know, just about everything is affected by oil prices at some point.
Eddie, I love how diplomatic you were there about Mark Cudmore's view. Well, it's an important point, but says Eddie. Eddie, thank you very much indeed for walking through some of the key market themes and pushing back against his boss on the energy and inflation. Very diplomatic. Eddie Van der Volt, of course, from our Markets Today blog. Thank you. You can get more from the team on the front page of the Bloomberg UK website by typing TLive Go on the terminal.
It is a hectic week. Have we said that enough times? It's going to be really busy on the central banking front, central bank decisions and politics front and centre. The UN General Assembly meeting kicks off in New York today. We'll be bringing you important conversations with business and political leaders throughout the week. On Wednesday morning, we'll get an update on UK inflation, closely watched by the Bank of England, of course, as it announces its rate decision later this week. So it's inflation on Wednesday, decision on Thursday. Also on Wednesday, the Fed's FOMC rate decision comes out. That's due at 7 p.m. at UK time, 2 p.m. Wall Street time. On Friday, there's no rest for the wicked. Traders will be looking out for the BOJ's decision, and we wrap up the week with that slew of flash European PMI data that we were just discussing there with Eddie. I am really fascinated then by the way that we'll sort of work our way through all of these central bank decisions and then get flash PMIs. So just as you think you know the state of the world, you get another look at the most recent high-frequency data about how weak and how stagflationary Europe looks.
Well, at what point do we cement that view that this is stagflation that they're looking at in the Eurozone, and will this week and that data be the cause for that, is a question. The Bank of England rate decision and the commentary from the BOE arguably more important, more interesting, because the challenge seems to be a little bit more acute in terms of the impact on the housing market. We'll be unpacking the impact of these higher rates on the real estate market and the housing market here in the UK. But given the commentary we've heard from Andrew Bailey and Hugh Pill in recent weeks, I think the BOE is the standout maybe in terms of where the interest is going to be.
Yeah, absolutely. Really interesting the way that this shapes up, whether we get reference to that Table Mountain shape to rates to come, whether that still remains the course of things from here, or whether... interesting to get their take on the housing market, and when we get to that peak patent point, when those 2-year and 5-year mortgage roll-offs really hit the UK consumer, because that, I think, is getting a date, nailing down a date on that seems to be crucial to any view on the UK economy.
Yeah, absolutely, as people look to refinance, of course, their mortgages. Worth highlighting what is happening across SocGen, because, of course, this is a company that is going through some efficiency changes. Caroline Conner has been on the ground in Paris for us with the news on this, and the stock is currently down close to 6% after unveiling that strategic plan. So it seems investors are less than impressed, at least for now, around the strategic plan after, of course, new leadership at the top of SocGen. Again, that stock down around 5.8%. We'll get an update from Caroline later in the hour.
And the view from Bloomberg Intelligence on this one, disappointingly, there are no major plans to restructure or refocus the struggling investment bank, which is compounded by a lack of a boost to share buybacks. So some cautionary words, I suppose, there.
Okay, coming up, if you didn't know, a big week for central banks. Consensus is building that the Fed peak rate may be approaching. But what are the markets pricing in, and are they getting it right? We'll get analysis next. This is Bloomberg.
deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Street is waking up. Europe is already trading. And starting today, Manus Cranny and Danny Berger will make sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, premiering today, only on Bloomberg.
That we are at the right level of interest rates in the EU to stop inflation and to reduce inflation. And this is the goal of these interest rates, to reduce inflation. We are on the right track. And I think, as Christine Lagarde said, that we should stick to that level of interest rates. It is the right level to reduce inflation.
Okay, French Finance Minister Bruno Le Maire saying that rates are at the right level to reduce inflation across the Eurozone, speaking to Bloomberg exclusively then, as increasingly you see leaders across Italy, Spain and France coming out with their views on that rate hike from the ECB. Let's bring in some analysis now, market analysis with George Barbaros, Managing Director at K2 Asset Management, on the ground in London for us. A great pleasure. George, thanks for joining us in the studio. Let's start with the Eurozone then. You're underweight European assets, European equities. Yeah. What would change your view? What would be the catalyst to make you more positive on European equities? Because some strategies we have come on, some guests will say, look, there's the valuation appeal, and then there's the cash returns, the dividends and the buybacks, but you're not compelled by that at this point.
Yeah, well, we maintain our underweights to mainland Europe. There's less predictability. We like North America, more predictability with policy, more predictability with the earnings profile.
Multiples are stretched.
They are. That's what more predictability equals, is you've got to pay a high multiple in return for that.
But at least you know you do.
You know you do. So that's where that overweight's been working quite well. Do the rotation, and then if you're going to price in a rate cut, which won't happen, but the market will, and they'll create volatility, but you'd be preempted. That's a Russell 2000. Take it back to Europe. It's just very complicated. So we know the hard landing's in Germany. Finance ministers doing what French finance ministers always should say: don't keep rates too high. Let's just keep it nice and low. So there's just a lot of uncertainty, and it's a bit piecemeal over there. We would rather even come over to somewhere where there's a bit more pain in Europe, in the UK, and probably look at this market, even though there would be odds on to do another rate hike here to address whatever they've got to address. Their stubborn inflation.
I was going to ask about the US, but that's just too tempting. So coming over here for some pain then, George, I mean, what are you looking at then in the UK in terms of UK assets?
Yeah, so the UK assets, unfortunately, it's industrials, and then when we're looking at the opportunities, energy to go overweight. And we've got some overweights in other parts of the world, looking at energy to go overweight again, and underweight financials, unfortunately. So that's, in the UK, there's some value play in there.
Underweight financials because the rate hikes have stopped or stopping soon?
Yeah, financials that can benefit from margins, obviously on lending. Some American banks are the big ones, more predictive again, overusing that word. So we like those, but we can't find that same case in the UK and Europe. Cost-income ratios, yes, they're improving, but they've got a long way to go to be matching the major financials in North America, which are looking much better. And again, it's easier to have a look at that profile of the earnings going forward 1 year. It's a bit more messy here. So we still like the energy play. And once again, rate cuts won't happen. It's high for longer, high discount rate, big headwind. But when people start pricing in rate cuts every second month for the next 12 to 24 months, it'll create that rally mechanism in there and that volatility, and then it'll just unwind itself as well. So people need to be cognizant of that.
Do you think we're closer to the risk premium here in the UK starting to fade, or do you see that being a prolonged...
High for longer here. You have some interesting issues that Australia do as well. You can compare the two different economies, but we're on top of inflation here. But the annual inflation rates, unfortunately, in developed markets on the year-on-year basis, they're going to worsen again by the end of the year. What's happening on the headline, and there's some stubborn services components. But nevertheless, if the UK goes through the pain earlier, the UK comes out looking better earlier as well for the developed markets. It's one way to look at it.
But thinking about US stocks, then. You say we are in line for a soft landing in the US.
Only the US, yeah.
Only the US, right. And because some people are worried about the US consumer. They've worked their way through those post-pandemic savings up to this point, and things get tougher from here.
Yeah.
Do you worry about that?
It is tougher, and we're always concerned, but we have to have a call. So I think most people say it's consensus now, where 3 months ago it wasn't, that the weekly data says soft landing on the cards. There are complications. Demand destruction equals pain. Consumers are feeling that pain. And there are some uncertainties in there, but it's the one economy, and it happens to be the largest in the world, that has odds on to get that soft landing. And once you get that high for longer rate into the system, Russell 2000, mid-cap stocks, small-cap stocks are very sensitive. There'll be a big rotation through there, just like in the UK. With your FTSE small cap index, they're very sensitive, and a lot of them just drop out and the new ones come in, and you've got your new growth structural cycle for the next 10 years with a higher discount rate, and that's a headwind, but it's not good for every company, but those high cash spending companies will benefit from that. I
think it would be remiss of us not to get your views on China, given the linkages between the Australian economy, where you're based, of course, predominantly, and that economy. You're very bearish still. I mean, there's an argument that maybe a lot of this negativity has been priced in. You saw the CSI 300 falling to a new year low earlier today. It's come back a little bit, but nonetheless, foreign outflows have continued. Isn't all of that bad news priced in? Isn't there a valuation play in China?
There is a valuation play, but more bad news, I'm afraid, very quickly. We've been overweight China up until March 2021 for 20 years on a structural basis. We're a structural decline in China after what Beijing did in March quarter 2021. It's very difficult to have long duration exposure there. So structural decline, PE, we wouldn't touch that. Tactically, though, yes, you can come in and out tactically on the equities, play that going forward, but they need finite capital from the rest of the world's savings. They've got issues that are beyond belief on the consumer and business sentiment. It just maintains those lows. The PMIs are repairing themselves just in the last 4 weeks or so, but structurally underweight. Tactically, overweight's where you can play it, but be very careful.
Right, and sticking with that theme, I remember hearing from Mohamed El-Erian, speaking to our colleagues in Italy recently, talking about China and the data and, the policy initiatives. And he was talking about how China is sort of tinkering with short-term policy when really what is needed is structural reform. Do you think other investors see the world the same? George, do you think others are also concerned structurally over a very long time horizon about China, rather than the sort of, yes, you can play it short-term?
Yeah, we believe as active managers, we're not the only ones that have gone underweight since March 21, after being overweight for multi-decades on the structural. Have a look at German economy. The highest correlation, high R-squareds with that economy in China, they're suffering the most pain. So there's your evidence for the pain. It will proceed and it will be there structurally for longer. Again, no private equity investments. We can't, that long duration for China, but we can see tactically short-term equity exposure, and again, underweight structurally for China. And they're going into the new trading brick economy anyway, 2 operating platforms. Price pressures aren't going to go down globally, but it's just a different operating platform for the next 10 years. Be very careful with these headwinds for higher for longer rates, and some stubborn regulatory frameworks around different regions of the world.
Okay, George, really nice to see you as you pass through London. Thank you so much for coming to talk to us. George
Thank you.
Bubaras, Managing Director at K2 Asset Management, with his views on rates higher for longer and the rest. Coming up on the programme, we'll dive into the Prosus and Naspers story. The CEO, Bob van Dijk, is stepping down. We'll discuss the implications of that for the investment firm and also for Tencent, because, of course, this business owns a big chunk of Tencent. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
This is Markets Today. Happy Monday, 21 minutes into the European trading session. You are lower across the European benchmark by 0.4%. Losses of close to 0.7 over in France and the CAC 40, and a drop of about 10 points here in the UK on the FTSE 100. Now, to a big corporate story and changes at the top. Prosus and Naspers CEO Bob van Dijk is stepping down as the head of the e-commerce investor and the board after almost a decade in charge. The group's CIO, Irvin Tu, has been named as the interim CEO. Prosus is the largest investor in Chinese tech giant Tencent. Let's go to Bloomberg's Lonnie Prince-Tu now in Joburg for the details. Lonnie, what has been then some of the key decisions taken under CEO Bob van Dijk? How consequential was he for this business?
Last 10 years, that's a decade of leading the company, and he's done quite a number of big shifts. One of them being spinning off the Africa Pay TV company called MultiChoice. They moved on, they spin out all the internet assets into what we now know as Prosus, which is a very big sort of e-tailer in Europe, listed in Amsterdam. They've started selling down their stake in Tencent and slowly buying back their own shares. And then this is all quite significant moves to try and also get the value for the sum of their parts outside of their Tencent stake.
Okay, Lonnie, so that's some of the impact that he's had, and of course, putting some of these businesses into the Dutch listing, a key part of what was going on here. Who is the new CEO or the interim CEO, and what have we learned about his plans or plans for the business from here?
Okay, so Urban 2 is taking over. He's from SoftBank, and before that, Goldman Sachs. Is known as a deal maker and a strategist. He's been with Process for the past 2 years. We've seen him also make some significant contributions in terms of the strategy, where the company is going. And the main point or the main focus of that strategy is to reach profitability by the first half of 2025. We've actually just spoken to Urban. He said he's going to take quite a hard look at everything, but they are planning to be very disciplined when it comes to mergers and acquisitions. That is because of current market conditions and the cost of deploying capital at the moment.
Okay, Lonnie, thanks very much. Bloomberg's Lonnie Prinsley joining us there from Johannesburg with the latest on Naspers and Prosus. Certainly some of the stocks we're watching this morning. Let's get a check on the other stocks on the move. Bloomberg's Lizzie Burden has a briefing. Lizzie.
Thanks, Anna. It's a pretty negative session here in Europe this morning, so let's kick off with the losers. SocGen, as expected, down this morning 6.4%. This is on the news from the CEO this morning that it's launching this cost-cutting drive. It's at the expense of revenue growth and profitability, and there are no major plans to restructure its struggling investment bank. So investors not liking that news this morning. Over to advertising, S4 Capital down 22.5% at the moment. This is after it's cut its full year outlook, and it's the second time that it's lowered expectations in just 2 weeks. So really struggling that one this morning. Also Lonza down over 7% this morning. This is of course the Swiss supplier to pharma and nutrition companies. Its CEO is to step down at the end of the month. No reason given for this unexpected departure, but we do know Lonza has been struggling. It's been challenging times for that company, and the chairman is going to take over from him. Finally, of the winners, and there aren't many this morning, I've picked out Mondi because it is the biggest gainer on the stock 600 this morning, up 4.7%. This is after the sale of its last remaining Russian facility for 80 billion rubles. It's going to get that payment in 6 monthly installments. So that clearly pleasing the market this morning.
Okay, Lizzie Burden, thank you very much indeed with some of the stocks on the move in this Monday session. It does stand out to me, S4 Capital, of course, founded by Sir Martin Sorrell, Anna, because of the slight litmus test it is in terms of the health of the economy. So recession concerns, they downgrade, as Lizzie said, second time that they downgraded their forecasts. And the line coming through from the team on the London Rush who've been analysing this, then it was particularly evident, apparently, in terms of these recession fears for S4 Capital, the digital advertising firm, 1 or 2 tech clients feeling a lot more cautious and seems to be reining back their spend, their ad spend. And so as we think about the depths of a recession that we might be going to here in the UK, this is one example of some of the pressures.
Yeah, you always look at marketing spend, don't you, as an area of pressure where businesses will cut back if they have the flexibility to do so, if they're worried about tough times or tougher times ahead. So there's sort of legitimacy at looking at that. I wonder how representative it is of the broader economy when they cite that reliance on tech clients. You know, perhaps that makes them slightly more beta to the declining fortunes of the UK economy.
And that question will be key if there's a broader read across. Absolutely. Across European markets, you're currently seeing losses of around 0.4%. In the US, S&P E-mini is actually turning up by about 0.1%. Similar picture for the Nasdaq after the losses of around 1.7% on Friday. Coming up, UK rents surge at the fastest pace in at least a decade, while home sellers increase asking prices for the first time in 4 months. We get a take from the Director of Property Science Innovation at Rightmove. That is next. This is Bloomberg.
half of all American women in opposite-sex relationships now make the same or more than their husband. That's a record high. According to a new report by the Pew Research Center, a third of U.S. women are in egalitarian marriages, making roughly the same as their husbands, and another 15% of them are the breadwinners. Women with college degrees and no children, as well as Black women, are even more likely to make more or the same as their partners. But not everything is a bed of roses. Working wives still carry most of the weight of unpaid labor. Women in egalitarian marriages spend almost twice as much time taking care of the home or a loved one, while dedicating less time to leisure.
Women are continuing to go out in the formal labor market and contribute and are still bearing all of the load of responsibility that disproportionately falls on them in terms of family care.
During the pandemic, in the wake of school shutdowns, the height of the childcare crisis pushed nearly half of American women out of the labor force, a trend that's yet to be reversed.
Women are just really struggling to meet the care needs of their family, and at the same time are really, really leaning into the labor market. And I don't think we've seen this before in history, to be honest.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
This is Markets Today, 30 minutes into your European trading day. Here are your top stories. European stocks follow Asia lower as traders gear up for a week of policy decisions from the Fed, BOE, BOJ and more. The United Auto Workers Union rejects a 21% pay rise from Stellantis as a no-go. The strike against the big three US car makers enters another day. Plus, SocGen slumps as the French lender cuts its revenue target as its new CEO focuses on costs and building capital buffers. Lots of interesting individual stories then, Tom. The SocGen is one of them. You pointed out some of the advertising news out of London. That's also really interesting. The overall mood in markets a little bit sluggish this morning.
Yeah, maybe that's the reason to focus on some of those individual stories. There's a bit of catch-up, as you've been reflecting on through the last hour or so, in terms of the downside we saw coming through from Wall Street, and a soggy session, quite frankly, across Asia. More concerns once again around the property sector of China. Some key deadlines for country gardens. So you're seeing some downside across the benchmark of 0.3%. The banking sector does stand out for us, given the downside, the drops that we've seen, almost 7% at one point for SocGen on the cuts to its revenue forecast. That is certainly weighing on the CAC Cajon. Over in Germany, the DAX is down by 30 points, off by 0.2%. The FTSE 100 remains above that 7,700 level. It's had a good week or so, currently unchanged. The basic resources play has been significant in terms of reviving, at least around the edges, the sentiment for the FTSE 100, which continues year to date to underperform many of the other major markets. Across your main sectors then, the breakdown as we reflect on what's happening in energy. There's a really big focus now, given the grind higher in oil prices and expectations that we may not be that far away from $100 a barrel oil, close to $95 a barrel in the session today. Trying to reflect on the energy sector. Currently, a little bit of green coming through on the back of that higher oil prices. Chemicals, though, down 0.6%. Travel and leisure also off by about 0.4. Similar picture for construction. Banks down 0.2%. Again, unpack that, lift the lid, and it's SocGen that is the most interesting at this point. Basic resources flat, and autos down by about 0.2%. Anna.
Okay, let's focus in on the UK property market then, Tom. According to a lettings index from the broker Hamptons, rental costs are growing at the fastest pace in at least a decade. Meanwhile, data on the sales market from property website Rightmove suggests asking prices rose in September for the first time in some 4 months. Let's talk to Director of Property Science Innovation at Rightmove, Tim Bannister, who's with us this morning for a take on the UK housing sector. Tim, very nice to have you with us. So in terms of the sales picture, you've seen this monthly price rise, 0.4%. Sounds, at the margins as if this could be something more positive than the messaging we've been getting from the housing sector of late. But we usually see this in September, don't we? And this comes a little lower than the usual uptick in the month of, in this particular report, in the month of September. What comfort do you take from this particular report?
Yeah, there are a few things. You're absolutely right there. So it's up a little bit on the month. It normally goes up at this time of year. This is a bit lower than it would normally we'd normally see. So 0.4 versus 0.65 or so. And I suppose year on year we're down 0.4%, which is the biggest fall we've seen since sort of March 2019. So I think what we're seeing here is it's been quite a subdued August. We saw that in terms of the number of properties coming to the market, for example. That was down 6% or so versus the average, longer term average. And so we've seen people step away for holiday, and I think we've seen that reflected a little bit, people a bit more subdued in terms of pricing. I think perhaps sellers are, they're taking heed from conversations with their agents. They're pricing competitively and starting to price more competitively because we know that's what you need in order to get a sale at the moment. It's not the same market as we saw, back in the early part of 2022 when it was incredibly frenetic and properties were selling super quickly. It's a different market now. It's still quicker than it was back in 2019, but it's certainly a different market compared to what we'd seen over the last sort of 3 or so years.
Tim, how much of a sense do you think, or how much more of a need needs to come through from sellers to be even more competitive in this environment of higher rates? Yet some mortgage rates have come off a little bit from recent months. Is there a need, do you think, there's an expectation that prices are going to have to come down that much further to keep the momentum going?
Yeah, I think when we speak with agents, they're telling us that, if you are coming to, you really need to really be thinking about being competitive. So that might mean if you've got a property on the market at the moment, about considering a reduction if it hasn't been selling, because those properties, as I say, that are priced correctly and are priced competitively, they are selling. So if your property hasn't been selling, it's probably worth considering a few aspects, one of them being price. So we have been seeing that with sellers doing that. They've been, so the proportion of properties on the market at the moment which are reduced is about 36%. The long-term average is more like 31%. So we've been seeing a few more of those reductions coming through, and I think that is, what we need to see in terms of being competitive, making sure you're pricing correctly so that these sales do occur. The demand is still there, so demand's about the same. It's about 1% down compared to 2019 levels. In the first-time buyer segment, it's actually up compared to 2019 levels. But we still need to see competitive pricing so that those trades occur. They're about 18% below in terms of sold subject to contract compared to where they were back in 2019 at the moment.
Okay, that in itself, though, I mean, that's not as bad as it could have been, I suppose. In some people, when you think about property prices falling, and that's what we've heard from many places, the fact that volumes are only 18% lower than 2019 levels. I mean, maybe it's my expectations were that it could have been worse. Let me ask you about where things get worse, I suppose, Tim, for the property sector, because a lot of people are trying to pinpoint when is peak pain for this story. And our own survey of Market Live readers here at Bloomberg suggests there is more to go in terms of the prices coming down. Rates look set to go higher from here, certainly this week. But also the other dynamic to watch is when mortgage customers roll off these 2-year fixed and 5-year fixed. What is your assessment of when the peak pain point is for the UK property sector?
Yeah, I suppose it's really difficult. Crystal balls haven't been worth much over the last sort of 3 or 4 years, I think, with so many different dynamics, so many, and it's also an emotional thing as well. This is about people's homes. It's not something you do on a whim. It's something you plan for many, many years before, and it normally coincides with a life event. So that really has to be brought into the thought process as well. We think there's we said at the beginning of the year we thought prices would be down. This is new seller asking prices. The number we publish and track would be down about 2% on the year. We're sticking with that. From where we are right now, that would mean a sort of 3 to 4%, 3 or so % fall at this point. It normally falls probably about 2% between now and the end of the year because of the seasonality of pricing. So we think there's a bit more to come in terms of when we look at prices. But, you have mentioned a few more positive, tentative positives there. We are seeing, despite the fact Bank of England rate is likely to go up, we've been seeing lender rates come down 7 weeks in a row, albeit they're higher than they were a year ago. But that trend of them coming down and perhaps stabilising is positive. Obviously, we know it's difficult as well when you see when you consider wages, but they are, we have seen sort of real wage growth as well. So there are some tentative positives there for people. I think they want stability. We know they want to move. And it's a question of sort of that demand side staying where it is or increasing, which I think we've started to see a little bit after the summer holidays, and making sure that those prices are competitive and some of those other metrics continue to move in a more positive way.
Tim, before we let you go, any kind of interesting regional differences that you're seeing bubbling up through the surface as a result of some of the changes in this UK property market?
Yeah, there's some regional differences and sort of property segment differences. So in terms of the year-on-year picture, those prices which have been slowing down a little bit faster tend to be the south and sort of the eastern side of the country, perhaps where people are, the affordability element is a little bit more stretched for people. And the segment-wise, it has been those larger properties. But I suppose it's worth bearing in mind, if you think back over the last sort of 3.5 years, larger properties in Wales, they're up sort of 20-30% in terms of price. Smaller properties in London, first-time buyer type properties, they've only moved about 6% over the last 3.5 years. So if you look on the longer term, there's been quite a different performance by region and by sector. And I think that's what we're seeing reflected now in where things are going.
Okay, Tim Bannister, interesting deep dive on the UK property sector as prices just edge a little higher in the month, but we'll see if that can be sustained. It looks like there are still many challenges still for the sector. Director of Property Science Innovation at Rightmove. Now, SocGen is trading sharply lower this morning after announcing its strategy update. Investors are disappointed. We're going to have more on the French bank next. This is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas and I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. Some of the things that one reads about now remind me of growing up in Mississippi.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
How's business in the UK doing?
Business in the UK, obviously it's our market. So we've just opened our 4th store in London. We just renovated our store in Bond Street, which is fantastic, super exciting. Yeah, we're very positive.
Your chairman has had a go at the government for actually not helping luxury companies or retail companies out more with VAT refunds. Are you missing out?
Well, we're not missing out. I mean, overall, globally, our tourist sales have obviously been increasing in the last couple of years, which is a positive. So that's a good trend. Unfortunately, there is a gap between our tourist spend growth in mainland Europe versus the UK, which is disappointing, especially as it's our home market. So we'll keep communicating that. We think probably post-Brexit, it would have been an opportunity. It would have been an opportunity to bring more tourists in. So we hope that sometime soon things will change.
Will the government listen?
I hope so. Well, we keep talking. It's not just us as well. I think there is a big movement to keep communicating about the frustration of it. But we're also concentrating on celebrating, our brand here in London Fashion Week as well. So still lots to do.
Jonathan, are you missing the Chinese tourists in London, or are they spending elsewhere, or is it really a loss of revenue?
I wouldn't say we're missing them. As I said, generally our tourist growth has been impressive globally, so it's just spreading around globally. So, even into the UK as well.
So, when you look at pockets of growth, where are you doing especially well, like regionally?
Regionally, well, our quarter one results that we communicated in May, we showed good growth in Europe. So Europe has been strong. Also very positive in Southeast Asia, APAC, and China.
That was the Burberry CEO, Jonathan Ackroyd, speaking to Bloomberg's Francine Lacroix, confusing tourists all over the place as renaming that Bond Street station as Burberry Station. Anyway, we'll move on because the chart on your screen is nothing to do with Burberry and fashion. It's all about banking. SocGen trading at its biggest discount to book value, compared to other peers in European banking, Tom. And what stands out on this chart really is the fact that, lots of them are trading at discounts to book value, which is interesting in itself. But of course, SocGen taking a dip down on today's news flow.
Yeah, an interesting top of the list, the least badly performing is UBS after that takeover, of course, is Credit Suisse. The stock, by the way, for SocGen currently down about 6.5% on the back of this restructuring plan. The details around the shift there at the bank. Let's cross over now to Bloomberg's Caroline Connor in Paris, who's been covering this for us. Caroline, disappointment in terms of investors in SocGen on the back of these revised forecasts. What is kind of standing out for you around the changes at this bank?
Remember, Tom, just 1 hour ago, I was telling you I didn't see any wow effect in this press release. Well, clearly, investors did not see it either, and they are disappointed with the profitability target, with the revenue targets. Basically, the new CEO, Slawomir Krupa, is trying to cut costs at the expense of revenue growth. This was supposed to be his big day after 4 months at the helm of Société Générale, his big capital markets day in London. Well, if you look at their revenue growth target, they're targeting between 0 and 2%, when under the previous CEO, Frédéric Oudéa, it was a 3% target. And also, investors are disappointed on the return on tangible equity, which is a key measure of profitability. Also, they have been lowering their targets. Finally, of course, dividends a key measure for investors as well. They're lowering their payout to between 40 and 50%. It was 50% before. It is 60% at BNP Paribas. So clearly, investors are disappointed there. The BI analyst from Bloomberg Intelligence, for example, is saying that caution is outweighing growth hopes. He was also hoping for more details, more restructuring plan at the investment bank, which is where Slawomir Krupa is coming from. Frédéric Oudéa, the previous CEO, had put a lot of focus on the investment bank at a time when there was actually tougher regulations. He also miscalculated, for example, the importance of asset management by selling a stake in Amundi. Well, we were expecting some changes, some clarification there as well on the investment bank, and this did not come with this press release this morning.
So a bit of disappointment, perhaps, that there wasn't more detail there or any kind of revamp. What does that mean? What does all of this mean then for the French bank from here, Caroline?
Well, clearly, another analyst was saying that this doesn't really solve the longer structural problems of the French bank. You were showing earlier this graphic showing that SocGen actually is trading at the lowest price-to-book ratio among the big European lenders. So clearly, This is not going to help. We will see, however, the Capital Markets Day in London today starts at 9 UK time, so in a few minutes, and we'll see actually if there is more details, for example, on asset disposals, because this is also something investors are looking at. How he's going to cut costs, how he's going to dispose of some assets. He's already said he's going to dispose of 4 units in Africa. He's reviewing another unit in Tunisia, also reviewing the asset custodian unit, which could bring 1 billion euros. So perhaps more clarity on this should perhaps throughout the day reassure investors, and we'll see whether the share price actually rebounds during the day with the comments of Slavomir Krupa.
Okay, so we'll look for those details later today. Caroline Connor on the ground for us in Paris, outlining that story for us. Currently the SocGen down 6.7%. Coming up, our Treasury yields showing a structural shift in behaviour during this tightening cycle. We discuss next. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg Markets today. We are 51 minutes into the European trading day. You can see some modest losses coming through across most of these European equity markets. The FTSE 100 stands out to the upside, up 0.1%. And US futures just improving a little at the margin, up by 0.2% on E-minis and NASDAQ futures. Tom, we've spent quite a bit of time over recent days and weeks, in fact, thinking about higher commodity prices. Oil prices go higher today, up 0.8%, 94.68 on Brent. But we shouldn't only focus on oil.
Yeah, there's some divergence, at least when it comes to Brent and diesel. So we are, of course, absolutely focused on that Brent level, around $95 a barrel. It's the most read, one of the most read stories of the day, and rightly so, for inflation reasons and for those concerns around what it could mean for a drag on growth. But it is nothing compared to the price action you've seen in diesel, the upside that you've seen come through from diesel. This chart illustrates it, the blue line, and that encompasses diesel as a component. You're seeing that it actually got above $140 a barrel last week in the United States. The European equivalent is up about 60% just since the summer. Here's Brent sniffing the edges of $100 a barrel. Diesel, though, above $140. Why is that? That's because the refiners are absolutely squeezed in terms of the amount they can produce. They are just under huge amounts of pressure. They've got all this demand for jet fuel, so they're focused on that. A lot of the refiners had to kind of pause refining during the summer months because of heat in a number of countries, and they just frankly shuttered a lot of the refiners during the COVID-19 pandemic when demand, of course, for all these fuels dropped off a cliff. So there is this crunch point coming through for diesel, and if you flip it over to the quote, the impacts, of course, across this global economy, because diesel is the workhorse for so much of industry, is really important to remember. Diesel, the fuel of the 18-wheeler truck that moves products from factory to market, and when prices spike, those higher transportation costs get passed on. One of the quotes in this Bloomberg piece on the higher prices that are coming through for diesel, what it could mean, Anna, for inflation and for growth.
Okay, let's pick up on that and think about what all of this means for Treasury markets. So there's the focus on commodity prices going a little higher, what that means for inflation. But let's take a longer term view. Ven Ram joins us from our Markets Live team with views on the markets. And your interesting piece recently, Ven, really caught my eye. Sticky Treasury yields show structural shift in market behaviour. This is all to do with investor time preference. Tell us what's happening in Treasuries.
It's a very interesting phenomenon going on in Treasuries, and as you know, Treasury long-dated yields have stayed pretty sticky. And why is that? You need to go back and look at the real rates, inflation-adjusted rates. We were deeply negative in inflation-adjusted rates a couple of years ago at the start of the pandemic. Now we are at 2% on the 10-year TIPS yield. So why is that happening? What is underpinning that increase? I think what may be at work is a shift in investor preference. What it simply means is that consumers are having to decide between consuming for today and saving for tomorrow. And after the uncertainty generated by the pandemic, the uncertainty around general life, investors are thinking, you know what? We are going to consume it right now, right here. Why leave it for tomorrow, which is uncertain anyway? And if they're going to do that, they're going to apply a higher discount rate on anything that they buy, including bonds, which is why real rates have shot up.
Ben, how much focus do you have on, and we look at the real end, we look at yields, I should say, on the back end, 10-year currently at 435, just heading up 2 basis points. Ben, we're thinking about the dot plots that they're going to be released later this week with the Fed decision, of course, and they currently have expectations of another hike this year, and I believe cuts of about 1% next year. How important are the dot plots? Do they take on more significance this week than maybe at previous meetings? What are you looking for?
Definitely, Tom. I think that the markets, I mean, the key signaling that the Fed will do will come from the dot plot. And they want to push back on this market's idea that the rate cuts are going to come fast and furious in the first half of 2024. They definitely do not want the markets to believe that narrative just yet. And what that means is that they can only signal that by pushing the dot plot higher for 2024. At the moment, in June, they predicted 1 percentage point of rate cuts in 2024. I do think that they are going to kind of narrow that margin, and they are going to say 75 basis points, or maybe even just 50 basis points of rate cuts coming in 2024. That will, of course, be pretty hawkish.
Okay, yes, absolutely. We'll focus in on the dots, what they leave room for this year and the amount of cutting they expect to see next. Ben, thanks so much. Ven Ram from our Markets Live team. Thanks for bringing us your thoughts. NN Live Ego is the function to use on the Bloomberg terminal if you want to keep across the Markets Live blog. Tomorrow, I'll be speaking with the German Finance Minister, Christian Lindner, at the Future of Finance conference. That's a Bloomberg event taking place in Frankfurt, so I'll be hot-footing it today.
We're going to miss you. That is one interview not to miss, though. That is it for Markets Today. You can get insights from us and the rest of the team, of course, on the website. Stay with us. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. And market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, in for Francine Lacqua. Here's what's coming up on today's program. Societe Generale slumps the most in 6 months as the CEO's first strategy update underwhelms investors. Meanwhile, oil pushes closer to $95 a barrel as OPEC Plus supply cuts squeeze the market further. Plus, stocks fall as traders stand by for a big week of central bank decisions from the U.S. to the U.K. and, of course, Japan and around the world. Let's start off the show by taking a quick look at the European markets map. You are seeing quite a bit of movement, but a little bit of red on the screen. Now, a lot of the sentiment is going to be coming from Asia. I think the real underperformer here is going to be in France. The CAC 40 really taking a hit here. That's going to make a lot of sense as we talk about which economies are going to get hit hardest by the ECB. Of course, you are seeing a pullback in the DAX as well. And, of course, the FTSE 100, though, not as much action. That's going to be significant, again, as we talk about the read-through from the BOE. We hear from them later this week. But, again, the real underperformer comes from France. The Euro Stoxx 50, I should say, as a whole, down about, we'll just call it 0.3%. So that's going to be your market map for you. But, look, it all comes down to central bank decisions right now. Let's take a quick look at the Federal Reserve here, because this is really going to be the tone setter for the rest of the week. Pricing already suggesting that if we do get a hike, this might just be the last one. Maybe the 2-year saga that we've had for the Federal Reserve, well, this is the end of it. And this is really what that chart is showing. At the core, though, what is driving inflation? I want to bring it to my next chart, oil and bonds. We're talking about oil hitting $100 a barrel. Does that actually spark inflation? Remember when we were just amping up the inflation story in 2021? Bond yields following the oil market tick by tick. That no longer seems to gaze. As we start to see oil's rally really strengthen, bond yields not following the same story. It really tells you that perhaps inflation won't be driven by the commodity story. Where will it be driven by? Wages. At the core of it seems to be the labor conversation. And it's not just about payrolls anymore. It's about the global story about just how much labor actually costs. This chart is one of my favorites here, because, of course, we are fully following the United Auto Workers strike. But take a look at this. Auto workers, essentially the backbone of Detroit's economy in the United States, the assigned auto working industry, is actually taking a way bigger hit than all of its peers in some of the manufacturing sector. That is going to change. What does that mean for the end consumer? Net, what does that mean for inflation? That's going to be a big story from the economic perspective, but also from a financial perspective. That's going to be something that, as we start to see priced into the markets, might benefit some of the banks and the way they are trading very specifically. So again, keep your eye on what the banks really take their cue from on that, at least on the front, in the U.S. front. Here in Europe, you're already seeing a little bit of mixed reaction to the banks, a lot of it coming From SocGen, shares slumping the most in 6 months this morning as cuts to revenue and profitability targets underwhelmed investors. Let's get to Bloomberg's Caroline Conan in Paris. She is all over the story. Caroline, walk us through the strategy update from this morning.
Could you remember a few hours ago we were saying that we didn't see anything spectacular in this strategic update in terms of numbers, in terms of new targets, only very slight changes? Well, clearly, investors are also disappointed. The shares opened minus 7% for Société Générale. Clearly not very good when it's a new CEO, Slawomir Krupa, who is presenting his next strategic update after 15 years of the previous CEO, Frédéric Oudéa. So clearly here he wanted to focus on cutting costs and limiting the risks, for example, on risks-weighted assets. But clearly that has kind of outweighed the problem that you have with the average revenue. The average revenue growth new target is between 0 and 2%. It was 3% before. This is a disappointment for investors. Also a disappointment in terms of the profitability target, with the return on tangible equity slightly lower. And finally, a disappointment on dividend payouts. The payout under the Frédéric Oudéa as CEO was 50%. Now it's between 40 and 50%. So investors are not expecting a high payout with this new CEO. Already, SocGen missed out on their 50% target last year due to the big 3 billion euro hit they had in Russia. SocGen was one of the most exposed banks in Russia. So a disappointment for investors. One BI analyst actually said that caution is outweighing growth hopes.
I mean, it's a really interesting dynamic, especially when SocGen is kind of lagging all of its European peers, not just its French ones. Caroline, how does it target this going forward?
Yeah, and if you look at the share price for the past 15 years under Frédéric Oudéa, they've actually lost more than 40% of their value, even if they've slightly recovered with the prospects of this new CEO, with the prospects of this new strategic plan since the lowest point this year in March. But the price-to-book ratio of SocGen is the trades at the biggest discount among European lenders, and it seems like this new strategic plan is not going to change much things, at least in the short term. One analyst is also saying that in the long term, the structural issues remain. Some other analysts are saying they wanted to see more restructuring at the investment bank. We'll see also if today, during the Capital Markets Day, which just started in London a few minutes ago, we will get more comments from Slawomir Krupa, more details, for example, on asset disposals. They've already announced the disposal of 4 units in Africa. They're reviewing another one in Tunisia. They're also reviewing the sale of their asset custodian unit. We'll see. We'll get more details to reassure investors throughout the day.
You know, Caroline, I always joke that you couldn't pay me to be a central banker. I got to say, you couldn't pay me to be at the helm of a European bank either. Caroline Conan with our update on SocGen from Paris. We thank you as always. And like I said, you can't pay me to be a central banker, yet some people still do the job. It's a massive week for central bankers this week. The Fed really takes center stage. The FOMC rate decision on Wednesday, the BOE in action on Thursday, and the BOJ on Friday. 3 different brains, 3 different spotlights, 3 vastly different takes on the global economy. Bloomberg's Zoe Schneeweiss joins us now for more. Zoe, let's start with the Fed here. So if we're not expecting a hike, what are we expecting?
So what we're expecting is some hawkish language regarding November. Overall, as always, the dot plot here is key, and Bloomberg Economics predicts that that will actually show another rate hike in November. But it is very close. And why is it so close? Firstly, the November 1st is the next rate decision, and before that, any data we will get are likely to be very mixed, not really showing a clear indication for a hike or a hold. And what makes things matters worse is that the United Auto Workers strike and a potential government shutdown, those events won't be showing in the data, so that makes it difficult. Overall, Bloomberg Economics does think that it's going to be another hike in November, but again, a close call.
I mean, it's a really interesting dynamic, again, because off the back of the ECB decision last week, we're already getting a lot of pushback from the fiscal authorities. I believe the best example I can give is that over in Italy, Matteo Salvini said Lagarde is literally on Mars. That's how much pushback there is about the effects of these rate hikes. Let's talk about the Bank of England, Zoe. Could we start to see the same pushback against Andrew Bailey as he's expected to hike?
So Andrew Bailey himself said earlier this month that the BOE is likely to be near the peak of its hike. So 25 basis points this week is almost certain. One thing here is the BOE will want to keep open that optionality to say maybe we're at the peak, maybe not. Just because in the current situation, central banks, if they cement themselves into a position that just does not work well, and that doesn't give them the flexibility, quite honestly, that they need, and central banks are data dependent, and the BOE's comments are likely to reflect that.
Again, 3 different banks, 3 very different results, I imagine, the back half of this week. Bloomberg's Zoe Schneeweiss all over that story. We thank you, as always, for joining us this morning. Coming up on the program, enough is enough. France's finance minister on the prospects of another ECB interest rate hike. We're going to bring you more from an interview with Bruno Le Maire. That coming up next. This is Bloomberg.
brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Wall Street is waking up. Europe is already trading. And starting today, Manus Cranny and Danny Berger will make sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, premiering today, only on Bloomberg.
Say I hope they get it right, because it's not so easy when you have so heterogeneous inflation rates around Europe. Spain, for example, has the lowest inflation rate right now at 2.4%, but other countries are proving to be much more resistant to lowering inflation. So I hope they get it right, and from the national perspective, I also hope they stop now, because our inflation rate is already quite low.
From a national perspective, what you say is a country like Spain does not need rates going above 4%. That's basically what you say.
Well, I think that this is a good summary of
And you said two interesting things there. You said that there's a conversation about duration and the level of it. But I wonder if there was another hike, and the market does not believe that for the time being there will be another hike, but is there now a real risk that if you were to go tighter, this is now really going to send this economy into a recession? You're suffocating the European economy.
Well, again, you know, it varies very much between the different countries. We were just starting our Eurogroup meeting here, as you said, in Spain, in Galicia, in my region of origin. And what we see is that the situation of the different economies is very, very different and very heterogeneous. Again, you know, Spain is the strongest growing economy in the EU. It is projected to be the strongest growing large economy in the Eurozone next year. Again, the forecast is for 2.2% GDP growth year on year this year, after very strong growth in 2021 and 22. So in the case of the Spanish economy, the prospect and the forecast is quite positive. But indeed, there are some other countries that are slowing down or even having a recession, and that has an impact overall.
And yet, as a finance minister, you also know, however, you say your projections were upgraded on that. It's very fair, but when you look at the indicators, it seems there's a loss in momentum, and there is some kind of pessimistic take on the economy now, where some say we're heading into stagflation. Is that something that you say not so fast?
Well, absolutely not. I mean, when we're talking about 2.2 GDP growth in the case of Spain after above 5.5% last year and the previous year, I don't think that would be an accurate word, you know, to describe the situation. We're having quite resilient growth, strong growth in our economy, and inflation has gone down by 8 percentage points in 1 year. So I'd say that would not be a good description of the Spanish economy.
Our exclusive interview there with Spain's economy minister, Nadia Calvino. She's saying the ECB is probably done with tightening, speaking there to our Bloomberg European correspondent, Maria Tadeo. Let's stick with the theme of Europe and central banks. Joining us now, Raffaella Tenconi, founder and chief economist of ADA Economics. Raffaella, a pleasure to have you on the program. Let's start with what Nadia Calvino was saying. She's not alone in simply saying that, look, we are done with the rate hikes, at least from the fiscal authorities in Europe. Is that enough pushback, do you think, against the ECB to really register?
Hi, good morning. Well, I think it's a strong signal that indeed it hurts at this level of interest rate. I don't think it really changes the ECB's trajectory. I think a December rate hike is still plausible because the labor market is going to stay resilient. But it is true that interest rates are very restrictive, and willingly or not, the ECB is going to have to cut very aggressively next year.
What would President Lagarde actually do when perhaps revisiting some of the way that the ECB targets the European economy? Because again, it's quite clear not all is created equal. If you were President Lagarde, what would you do, Raffaella?
So I think the consequences of keeping interest rates too high for too long in the Eurozone is first of all on productivity and investment. So Lagarde has already said she expects the second half of the year to be weak, but she expects 2024 to be a rebound. If she doesn't handle the communication correctly, then the risk is that invest for 4 quarters, and that has direct consequences on productivity long term, which eventually also hurts inflation. The other issue is also on the distribution of upside. So what we see is that, of course, if you're younger, energetic, or very large company, you're doing better. And then there are a large number of companies that are not as well equipped in the transition. So there is a distributional effect, which eventually also impacts productivity and social cohesion. So if I were Lagarde, I would frankly drop this data dependency communication, which is very 1980s, frankly. And I would upgrade the communication to reflect a more candid assessment of what is the inflation challenge, which is difficult, but just let's be clear, inflation in the Eurozone is coming down. It is going to be between 2% and 3% next year. So she doesn't need to be this aggressive, right?
I mean, at least that is the take from a lot of the world leaders. I read over the weekend, I believe, from Bloomberg reporting that the leader of the league in Italy, Matteo Salvini, calling Lagarde, saying, she is living on Mars. So some real fighting words from there. I want to bring you some sound from the French finance minister as well, Bruno Le Maire. Take a listen to what he had to say.
I think that we are at the right level of interest rates in the EU to stop inflation and to reduce inflation. And this is the goal of these interest rates, to reduce inflation. We are on the right track. And I think, as Christine Lagarde said, that we should stick to that level of interest rates. It is the right level to reduce inflation.
Raphael, I bring you and our global audience that sound to really just emphasize how much pushback they are getting from these fiscal governments, because this is a dynamic you see right now in the United States as well. The idea that the Federal Reserve is trying to remain hawkish while Biden administration, I would argue state governments even, are actively pushing back against that narrative. Raphael, how much of the ECB is being led by the Fed here in terms of their approach?
I think they both trying to be very hawkish right now because they're afraid to lose even more credibility in the face of the market, given that the run-up of inflation, they miscalibrated. So I think they're both responding to a credibility puzzle. But that being said, I think the Fed is justified. There is a much stronger wealth effect and there's a stronger household demand today. So the Fed is correct in its stance, whereas the ECB really needs to guide the economy through this investment challenge. I mean, don't forget that the EU is trying to do green defense, nearshoring, especially recently. Eventually we'll need to do the rebuilding of Ukraine, digital transition. All of these transitions require very careful guidance to the private sector on what is the realistic medium-term cost of capital, which is at least 100 basis points below where they are today. So I think the ECB is missing the plot in the sense that the finance minister complain, as they always do, but they also pick up a real worry that the ECB is focusing too much on inflation today and too little on inflation in the medium term.
You say the ECB is missing the plot. I wonder if the Federal Reserve is as well. Raphael, let's shift to our focus to that Fed decision on Wednesday, because often when we talk about tackling inflation, the focus shifts to commodities. And yeah, this oil rally doesn't seem to be lifting break-even pricing or bond pricing at all. In fact, it feels like the biggest inflationary pressure right now is coming from wages, from strikes. You're seeing this from the United Auto Workers and other unions across the United States and across the world as well. Talk to us about how the Fed should approach very sticky wages.
So I think realistically, the way the Fed can approach wages is to provide more analysis, guidance, and data on the granularity of the labor market, because the labor market is very diverse. And these days, the average doesn't really reflect what is going on. So when you say that average wages are rising, for example, the pay award offered in the automakers doesn't quite reflect the fact that the magnitude of the change is big, but the level of wages, especially of the less skilled workers, is so low these days that they really cannot afford to raise a family realistically in the US today. So the problem with the Fed is that to get real credibility with the broader public, it should be very realistic in saying these are the consequences. There is nothing more that they can do because it's not really credible that you will push the economy into a 2008 style recession, which is what you will need to push the unemployment rate high enough to be disinflationary. This whole decade will see the labor market very tight, wages rising. There is no way you can get out of it.
I mean, a historic moment truly around the world, especially when it comes to the labor market. Raffaella Tinconi of ADA Economics, we thank you, as always, for joining the program. Coming up, we go from monetary policy to perhaps a little bit more of what the government can do. The death toll from devastating floods in eastern Libya tops 11,000 in just one city alone. That comes as hope fade for thousands still missing. This is Bloomberg.
what do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
The conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. The death toll from devastating floods in eastern Libya has surged past 11,000 in the city of Derna alone. The UN estimates that more than 10,000 people remain unaccounted for in the city after a rare hurricane-like storm slammed into the North African nation last week. Almost a quarter of Derna's entire population are currently either missing or confirmed dead. We, of course, will bring you more developments as we get them. This is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupied areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. Some of the things that one reads about now remind me of growing up in Mississippi.
Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. take a daily deep dive into risk, and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg.
Societe Generale slumps the most in 6 months as the CEO's first strategy update underwhelms investors. Oil pushes closer to $95 a barrel as OPEC plus supply cuts squeeze the market even further. Plus, stocks fall as traders stand by for a big week of central bank decisions from the U.S. to the UK, Japan, and around the world. Good morning and welcome to The Pulse. I'm Kriti Gupta in London. The United Auto Workers president has rejected a pay offer from Stellantis as a strike at the big three U.S. car makers enters its fourth day. Workers at plants in Michigan, Ohio, and Missouri walked off the job on Friday in a partial strike that's threatening billions in losses if it spreads to more plants. For more, we're joined now by Bloomberg's Oliver Crook in Berlin. He's all over this story. Ollie, let's just start by getting a kind of check on where we stand right now with the strike.
Right, so this was all precipitated because GM and Ford put 20% on the table, Stellantis put in 17.5% raises, and the workers, they're asking for 36%, and we're just at a massive distance there. In terms of palpably what came out over the weekend, well, first you had Biden speaking on Friday, coming out on the side of the union, saying that basically that the profits that these companies have enjoyed have not been really shared adequately among the workers. So what did we get over the weekend? Really concretely, that one raise, right? Stellantis saying 21% is now on the table. Here's how the president of the union reacted to that offer.
So 21% is a no-go for you?
It's definitely a no-go, and we've made that very clear to the companies.
And we knew that there were some conversations with Ford on Saturday, there were some conversations with GM on Sunday, but really, we're still at a massive distance here. We're talking about a 15% differential that has not really moved the dial on day 4 of this strike. We're going to have it just going to continue to roll on.
Well, really pulling a page out of the Teamsters playbook, really an aggressive approach. Ollie, what comes next here?
So today, Monday, we understand that Ford and Stellantis are back at the negotiating table with the union today, so we'll watch for any news out of that today. Then also this week, we're going to get a White House delegation that is going to Detroit, led by Gene Sperling, the economic advisor, and Julie Su, the deputy and acting head of the labor market, really to try to help facilitate and support these talks. What comes next for the strike? We don't know, and that is by design. Sean Fain has kept it deliberately ambiguous to preserve the strongest negotiating position. It's a wide strike across 3 states, but a shallow strike. Only about 10% of the workers in the union are currently striking. They've hit high margin cars, but they haven't hit the real profit centers yet. So we're still waiting to see if they're going to aim for those Ford F-150s, those Rams, and those Silverados.
Hitting America where it hurts, and it's ginormous cars, clearly. Does this spill outside of the auto sector, Ollie?
So what's interesting is that I think everyone globally will be watching this to a very large extent, right? This is in some ways very interesting and very material to the auto sector, yes, but this is a conversation that's going on globally in many offices. We can understand this very clearly because it's 150,000 people in a union, but as we go into the fall here in Germany, what we'll be watching is in October and November is when you get a lot of these wage negotiations. And of course, these wage negotiations are what is going to govern the path for inflation going forward. And so the question is, and it's one fundamental question everywhere, is how much power does labor still command, and how is that power distributed across different industries? We're about to find out in the auto sector, but we're going to find out in a great many other sectors for the few months to come.
And of course, now the White House headed to Detroit as well, I'm told. Let's see if anything progress comes out of there. Bloomberg's Oliver Crook all over that story. We thank you, as always. Now, when I think cars, we got to talk about oil as well. Oil extended an upswing as OPEC plus supply cuts tightened the market. It comes as the Saudi energy minister is due to address a conference on the kingdom's oil policy, as well as its view on net zero. Joining me now for all things commodities is Will Kennedy, Bloomberg senior executive editor for energy, as well as commodities. Will, before we get get into kind of the nitty gritty, there is a chart that I love this morning, and it really basically takes oil prices and bond yields and tracks them. The idea here simply being that oil prices were pushing up these bond expectations until the last month. What is the bond market getting wrong about the oil market right now?
Or what's the oil market getting wrong about the economy? I think what's happened here is that the oil price is supply-driven and not demand-driven. So in the earlier part of the year, a lot of people were interpreting the oil price as a commentary on where the global economy was, where the Chinese economy is, and that was very much in sync, perhaps, with the same conversation going on in the bond market. What we have here now is a concerted effort by OPEC Plus to assert a grip on the market to keep supply under control. They've extended those supply cuts until the end of the year. So now the focus of the oil market is very much on supply rather than demand, and supply happens outside the wider context of the global economy.
What about the pricing when it comes to refined products as well? What is actually driving what here? Is it the dog wagging its tail or the tail wagging its dog when it comes to oil and refined products like gasoline, like diesel?
So this is another thing that's very important about the oil market right now, is that the global refining system is looking pretty stretched. Through the pandemic, we lost a few refineries, and demand has come back very strongly since then, perhaps even stronger than some people predicted. And you can't use crude oil for anything. You need to turn it into fuel. You need to turn it into gas for your cars and jet fuel for your planes. And the global refining industry is working really very flat out to make that happen. That's widening the spread between some fuel prices and oil prices, especially for diesel, so important to how the global economy works, where we've seen some really strong diesel prices. So what consumers end up paying is perhaps even ahead of where the crude oil price, and we're seeing gasoline prices, although not approaching the very high levels we saw after the invasion of Ukraine, we're seeing gasoline prices at very high levels for this time of year, and that probably doesn't augur well for the months ahead.
I was going to say, or the years ahead. We've got a presidential election next year in the United States. That'll be quite interesting as well. Let's broaden this out, though, because the initial move, it felt like, in oil last year came from Russia's invasion into Ukraine. The conflict continues. How much of that is having an active effect in the oil market, but also broadly the entire commodity complex?
It's still a very important factor, but what we've seen is that the oil industry, the oil trading industry, has been able to adjust to the new facts on the ground. So Russian oil that would have previously gone to Europe is now very much going to customers in Asia. In fact, Russia appears to be finding new customers. We've seen several tankers go to Brazil in recent weeks, a new market for Russian oil. So people are having to work around the restrictions, the price caps. Perhaps Russia isn't getting as much money for its oil as it would have done in a pre-invasion world. But the world has adjusted, and the oil continues to flow, and the oil continues to find its way to the market.
If I only had more time, I would ask you how much exposure people actually want to this. But luckily for you, we're out of time. Will Kennedy, thank you as always for joining the program, who supports our executive editor for energy and commodities. Now, U.S. National Security Advisor Jake Sullivan and Chinese Foreign Minister Wang Yi have met over the weekend in Malta. Among the agenda items, a possible meeting between President Biden and Xi at the APEC summit in November. The Malta meeting comes at a critical time in U.S.-China relations, with Wang scheduled for talks with Russian officials in Moscow this week. Meanwhile, Germany's foreign minister says the European Union must reduce its reliance on China. Annalena Baerbock tells Bloomberg's Anne-Marie Hordern about how the region's strategy has changed thanks to the global fallout from the war in Ukraine.
We have learned our lessons from our Russian dependencies. And again, I believe it's a strength if you can be also in politics self-reflective, of saying, okay, this was obviously not the right way to go. We had such a high dependence on Russian gas and oil, but especially gas, that obviously in the past former governments took decisions which weren't the right one. Speaking about the gas pipeline Nord Stream 1 as a purely economic thing, nothing to do with geopolitics. And I was in a position back then, and I was also at the Yamal Peninsula, for example, where there was a source of this pipeline coming through. I spoke to many people there, and I could not only feel from our partners in Poland and the Baltics, but also there that this has obviously a geopolitical dimension. Before election, I was always arguing we have to not only trust on words, but we have to see the action. And now, when we came in government, we said already in our coalition treaty that we have to rephrase our dependencies. We formulated also before the Russian war that we will do a new China strategy. And after the invasion, the full invasion, we not only wrote the strategy, but we prepared for the things we should change in the future. And this is like limiting.
Are you worried about Chinese retaliation?
Yes. So first of all, understanding that if you're bound too closely, it can endanger yourself, especially if you are having such a high dependency of a regime like in Russia, which is in the end attacking your own peace order. So therefore, cutting down our dependency from Russia, but also now with regard to China, de-risking is our total understanding of the strategy. No decoupling, because you cannot decouple in an interconnected world, and a connected world is also way to peace. But we should be able to defend ourselves, not being naive, and so being a partner in climate issues, being a competitor, obviously, with China with new technology, but also seeing that we are systematic rivals, and we have to protect our own vulnerability. And this is where von der Leyen comes in, the Commission President, to strengthen our critical infrastructure in Europe, but also looking at outbound investment screenings.
German Foreign Minister Annalena Baerbock there speaking to Bloomberg's Anne-Marie Hordern as world leaders gather for the UN General Assembly Summit this week in New York. And tomorrow, German Finance Minister Christian Lindner will be speaking with Bloomberg Markets Today anchor Anna Edwards at the Future of Finance conference in Frankfurt. Terminal users can follow that conversation on LIVE Go on their Bloomberg terminal. And ahead of the UN General Assembly, Elon Musk has visited Turkish President Recep Tayyip Erdogan in New York. They've spent about 45 minutes discussing artificial intelligence and a potential Tesla factory in the region. SpaceX has also been working with Turkey's space program to launch communications satellites. Coming up on the program, public confidence in the Bank of England plunges to a record low. More on that story next. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
big change we've had is a lot more fiscal discipline from the government. So that's a real plus. And I think I'd almost put that, ahead of the rest of the globe in that way.
What I see, and what I hope markets and businesses see, is a UK government that recognises the importance of sound public finance.
I think for every 100 days, maybe there's 5 to 10 days when the UK and the Eurozone can pull the US around.
Wonderful entrepreneurial spirit, great education. So I think in the long term, you would still have to put UK at the top of the list.
Bloomberg TV guest speaking about the UK's economic outlook on Bloomberg Television and radio. I want to stick with the theme of the United Kingdom because public confidence in the Bank of England has plunged to a record low amid soaring interest rates and elevated inflation. That, according to the central bank's own survey of household attitudes. Bloomberg's Lizzie Burden is here. Lizzie, let's start with the dismal review of the Bank of England. It's kind of coming within from its own house. Talk to us about what we heard.
Yes, exactly. It's the inflation attitude survey by the BOE. As you say, public confidence in the bank at a record low. When you think about it, monetary policy is a game of expectations management, isn't it? And the Bank of England seems to be failing miserably. 2 in 5 people think it's doing a bad job of controlling inflation. But it's also bad news for the Prime Minister Rishi Sunak because his #1 priority is to halve inflation this year, and yet he isn't promising to do anything actively towards that end. He's only promising not to worsen the problem. So really, his political fate is somewhat in the hands of the BOE. But we get another decision on Thursday. The expectation is for a 1/4 point hike. The question is what the guidance will be around it. Will it clearly be that this is the last hike? Are we at the peak of Table Mountain?
And speaking of surveys, some bad news from the BOE survey, but some good news from the MLive Pulse survey. Walk us through it.
Well, good news if you're Keir Starmer. It shows that the majority of finance professionals who responded reckon Starmer, the opposition Labour leader, would be better for the pound and better for the FTSE. So it shows what a long way he's come in terms of wooing the business community, what he calls the smoked salmon and scrambled eggs offensive, this version of Tony Blair's prawn cocktail offensive. Because, of course, he's had to turn around the reputation from the time of Jeremy Corbyn, his predecessor. And to do that, partly, he's reversed the nationalisation plans and he's made ex-Bank of England Rachel Reeves his shadow chancellor, front and centre of his campaign at every moment.
Lizzie, we're about 20 minutes away from hearing from Liz Truss herself, the former premier, of course. Is she going to cause some trouble in Downing Street?
Well, I was going to say, on that MLive Pulse survey, it also shows what a difficult time Rishi Sunak's got, turning round the ship from this time last year when you had Liz Truss and before that Boris Johnson, the reputational damage. Look, we've had a trail of this speech by Liz Truss. It doesn't look like we're going to get any apologies still. She's going to say we're expecting that we've had 25 years of economic consensus. That's why we haven't got economic growth in the UK. So to me, that sounds a lot like the blob that she was talking about this time last year.
I wonder what that head of lettuce she was compared to has to say about that. Lizzie Burden with that story. We thank you as always. I want to stick with the UK story specifically. Talk about one of its largest companies, the Burberry CEO, saying tourists are spending more on luxury goods in mainland Europe than the UK following the loss of tax-free shopping for visitors to Britain. Jonathan Ackroyd spoke exclusively to Bloomberg's Francine Lacqua ahead of Fashion Week.
How's business in the UK doing?
Business in the UK is obviously it's our market. So we've just opened our 4th store in London. We just renovated our store in Bond Street, which is fantastic, super exciting, yeah, we're very positive.
Your chairman has had a go at the government for actually not helping luxury companies or retail companies out more with VAT refunds. Are you missing out?
Well, we're not missing out. I mean, overall, globally, our tourist sales have obviously been increasing in the last couple of years, which is a positive. So that's a good trend. Unfortunately, there is a gap between our tourist spend growth in mainland Europe versus the UK, which is disappointing, especially as it's our home market. So we'll keep communicating that. We think probably post-Brexit, it would have been an opportunity. It would have been an opportunity to bring more tourists in. So we hope that sometime soon things will change.
Will the government listen?
I hope so. Well, we keep talking. It's not just us as well. I think there is a big movement to keep communicating about the frustration of it. But we're also concentrating on celebrating, our brand here in London Fashion Week as well. So still lots to do.
Jonathan, are you missing the Chinese tourists in London, or are they spending elsewhere, or is it really a loss of revenue?
I wouldn't say we're missing them. As I said, generally our tourist growth has been impressive globally, so it's just spreading around globally. So, even into the UK as well.
So when you look at pockets of growth, where are you doing especially well, like regionally?
Regionally, well, our quarter one results that we communicated in May, we showed good growth in Europe. So Europe has been strong. Also very positive in Southeast Asia, APAC, and China.
Where inflation is actually leading it. Do oil prices really matter? Do gasoline prices really matter? That's going to be the question. We're going to ask Eddie Vanderwalt. He's kind of a little bit an expert in these matters. Stick with us. More coming up. This is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Welcome back to The Pulse. I'm Kriti Gupta in London. Now, stocks have slipped before a major week of rate decisions as oil ticks a little bit higher. There's a lot going on in markets right now. Who better to help us digest it all? Bloomberg's MLive's Eddie Vanderwalt, Deputy Managing Editor, joins me right here on set. Eddie, there's a lot going on in central bank decisions. You got the Fed, you got the Bank of England, you've got, I think, Norges Bank, I want to say Brazil. And before you rant about all of them, let's talk about the BOJ, because I think this is a really significant one. You're starting to see this idea that perhaps the BOJ might normalize, might get on the same page as the Federal Reserve. Is that a realistic expectation?
Yeah, the Bank of Japan, of course, is still very much, behind the curve, behind everybody else, with policy rates still in, deeply negative territory on a real basis. There is hope that they will look towards normalization, or that they might do something, on curve control. There's a lot that the Bank of Japan could do, and I think they are a wild card this week. But they are also very far behind the curve, and I don't think that they will shift the narrative globally. I think this will be a Japan thing if they move. I think that could have implications for the dollar, and therefore shift the market narrative globally, but I don't think that it necessarily will be an indicator of where the rest of the central banks are going to be.
Well, I think what's really interesting is the way it's getting priced into the market here, right? Because we're talking about kind of everyone saying, well, it's the BOJ. They'll never really act on whatever they're kind of indicating, even though, to be fair, Governor Ueda didn't actually say he was going to do anything. He just said it might be an option on the table, which, to be fair, Chair Powell and President Lagarde have said that plenty of times as well. Well, there's a terminal chart I want to show you here where yen swaps specifically in the FX market have already jumped the gun. They've already said, look, that higher rates are going to happen in Japan, and that is sticking. How much of a dislocation in the FX market is going to have ripple effects everywhere else?
Yeah, look, we saw that last time, right? We saw even on Ueda's comments, whenever he even talks about tightening, whenever they talk about policy normalization or lowering the amount of curve control, allowing their 10-year yields to rise above the 1% level, whenever we hear those sorts of things, it has an impact because you've got a lot of Japanese money sitting in other markets, and if that starts to come home, that will move FX, that will move the dollar. If you move the dollar, you are moving everything across markets. Yeah. So it is a really, really important, just pressure point for global markets, I think.
Yeah, 15 seconds. Do you think that all those people who are shorting those JGBs are finally gonna make that quick buck?
Well, that's a big call. I don't know. I think I would much rather look towards the dollar at this point and see, whether that rally that we've seen in the dollar is perhaps not coming to an end, because I think there's a lot of people who are shorting the dollar and might get themselves caught out here.
I mean, it's really fascinating because then on top of that, you also have the oil story, which is going to impact import prices, push inflation higher. We could go on and on and talk about the domino effect, which you taught me how to do. Eddie Vanderwald getting a taste of his own medicine. Bloomberg's M Live, thank you as always for joining the Pulse this morning. Now, up next, our brand new show debuts. Bloomberg Brief. The U.S. is waking up. Europe is already trading. Danny Berger is in London. Manus Cranny is in New York. The original Daybreak Europe crew are going to give you everything you need to know for our New York audience and for our European audience as well. You don't want to miss it. This is Bloomberg.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
things like solar or wind, it's nice and environmentally friendly, but really it's not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Slice through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Traders taking risk off the table ahead of a raft of policy decisions this week. Decisions due from the Fed, the BOE, and the BOJ. Global leaders gather right here in New York for the UN General Assembly as US-China tensions simmer and Russia's war in Ukraine rages on. We're also discussing all of that and more this hour with Nouriel Roubini, top economist who has a track record, quite literally, for predicting doom. Danny, let's see if we can shift the tone and maybe raise Nouriel's spirits. It's good to be reunited with you. I floated through Europe to help the economy, but it's good to see you. Back on form, back on the earlies.
I think Europe might need a little bit more help, Manus. Come visit me sometime and do that. But Manus, like an economist trying to predict where inflation goes next, I've been lost over the past few months without you. It is so great to be back and on a week nonetheless where we get, what, half of the G20 giving us rate decisions?
Correct. And I think we're going to know over a 36-hour period, really 6 out of 10 of the biggest traded currencies in the world. We're going to understand perhaps the definition of pause, pushback from the Bank of Japan, and maybe even a reinstallation of confidence in the Bank of England. Danny.
Yeah, looking forward to discussing all that and much more with Nouriel Roubini over the next hour, Manus.
Okay, let's set the tone for where we are with risk right now. We've got major headlines on the oil market. This is what we've got for you. You have the Brent crude careering towards $95 a barrel. Now, the question here is the hedge funds. They're the longest that they've been in 15 months. Prince Abdulaziz bin Salman will speak today in Canada. How much more emphasis will he put on the tightness that the IEA and that the OPEC forecasters see themselves? Again, we're debating whether we've hit peak pessimism on China, and that drives that oil market. Euro-dollar was careering lower last week, 9 weeks of losses. We paused for thought, but of course, it was Christine Lagarde who lampooned the euro last week, and the market is now obsessed with one of Nouriel Roubini's mega threats, which is stagflation. Let's ask him how that plays out. Short end of the curve this week in the US as the Fed meets. Will the dots really matter? Will they redefine where we are at the short end of the curve? What will the dots tell us about next year's trajectory in terms of rates outlook for the US? And that the global consequences of flow on the dollar and around the world are absolutely material for the back quarter. Danny.
And Manus, one of the consequences of higher for longer, the long pause, is perhaps tech can't perform the way it has been. We saw that on Friday. The NVIDIAs of the world, the Meta, all the big caps tech stocks took a bath. We are looking at a peak higher in S&P 500 futures, but we still haven't recovered the ground that we saw all that lost on Friday. European stocks, they're starting down 0.5%. I love this from Mike Wilson over at Morgan Stanley. He just got back from Europe and basically said that the negative attitude around stocks for 2024, it's not just a U.S. story. People in Europe are also negative. Good to know that we're also pessimistic on this side of the world too, Manus. This one's for you. I know even though you're in the U.S., you're never too far from a European banking story. SocGen falling 7.5%. A couple hours ago, they released a new strategic update. They've cut their revenue forecast. They've cut their profitability outlook, changed their dividend strategy. The market and KBW analysts say they are not too impressed. Manus, I, though, quickly want to go back to oil. You mentioned it. It's near $95 a barrel. We're starting to talk about $100 a barrel. But here's the thing. The oil boogeyman has lost its bite. We got a great chart for you showing that break-evens have barely moved up with the price of oil. And we had UMich survey last week on Friday. And that also showed us that the consumer, their expectations for inflation, Manus, are the lowest since 2021.
Well, I'll see you and raise you in that in terms of expectations, Danny, because if you look at the fissures of confidence, yes, inflation expectations may be slightly behaving themselves, but if you look at FCON, it is tightening. And with that in mind, we've got the surveys out from New York which show that the ability, the confidence to access credit is at the lowest in 10 years. And that is the beginning of the long variable lag in many of its manifestations. And if confidence on access to credit cracks for the consumer, then you begin to understand why Macy's and all the other major retailers were warning on delinquencies a little bit earlier. Danny.
Yeah, we just heard from Walmart last week saying that we're going to be living with higher rates for longer, that there's going to be more inflation sticking around for longer. Walmart is talking about that, Manus. Look, it's certainly a concerning thing.
Okay, let's set the agenda. We've got a trifecta of central banks. Those decisions are coming this week. We've got the Fed on Wednesday, the Bank of England on Thursday, and the Bank of Japan on Friday. The Fed is expected to hold steady as it assesses the effects of its aggressive rate hike campaign. Here's what Bloomberg opinion columnist Mohamed El-Arian had to say about the Fed's balancing act.
They'll pause. I don't think at this point they can hike, but they'll keep wide open the possibility of another hike, and they're going to push back against this notion that they'll be cutting anytime soon. The message will be, we're going a little bit higher, and we're going to stay there for longer.
Let's see what this man makes of it for the next hour. There's Nouriel Roubini, our guest host for the next 15 minutes, CEO of Roubini Macro Associates. Nouriel, good to see you. I know we had to tempt you in to get you up at 5 a.m. this morning.
Pleasure being with you.
Great to have you with us on the first show. So we've got this Fed meeting. All of a sudden, we now are trying to comprehend what higher for longer really means. Will that be manifested in the form of dots, or what does it mean for you as you look forward?
Well, of course, this week they're not going to hike rates, but whether this is going to be a skip or a pause is to be seen. Skip will be a case in which they don't hike, but then leave it open to hiking maybe in November or later. A pause will be a signal that, no, they're done. I don't think they can say they are done because the economy is still growing above potential. Headline inflation is going higher now that oil prices are going higher, and therefore potentially they have to leave the option open that there'll be another hike.
What is the most misconceived idea? A lot of people have lived through 5% rates before. You have, I have. I've lived through 15% rates, so have you. Is the greatest disconnect in markets that we are pricing 100 basis points of cuts next year when the reality is inflation is malingering, core CPI is still tight and hot? What's the greatest misconception about inflation?
You're absolutely right. I think that the markets are still thinking the inflation is going to drop towards 2%, and therefore the Fed is going to cut rate and cut them aggressively. The Fed is pushing back against that view. They're saying we're going to be essentially higher for longer, not just the Fed, but other central banks. There are structural forces that imply that inflation may be higher, from deglobalization to aging to geopolitics to other negative supply shocks. And therefore, I think markets are still a little bit too optimistic that the Fed is going to aggressively cut rates starting early next year. That's not going to be the case. At the earliest, the Fed is going to start cutting rates maybe towards the middle of the year. Yes?
Danny here in London. Great to speak with you, Nouriel. On that point, look, it's a world saddled with $300 trillion worth of debt. If the Fed isn't going to cut as soon as expected, what happens when we hit that maturity wall come next year?
Well, you're absolutely right. I mean, we live in a world in which there is too much private and public debt. In addition to the official public debt, there is also implicit liability coming from unfunded Social Security and healthcare liability coming with aging. And I think that one of the threats, of course, is not just the trade-off that central banks are facing between growth and inflation, but is actually a trilemma. They have to worry about financial stability. And the more you raise interest rates, and the more they go higher on the short end and the long end of the yield curve, the more there are risks of financial instability. You saw it in what happened in the United Kingdom about a year ago. You saw what happened in the spring of this year with the stresses in the financial system. I don't think we are out of the woods. As rates have to stay higher for longer, the possibility of some degree of financial instability is still with us.
Well, I was going to say, to start the year, there'd been a lot of fear-mongering that QT would perhaps cause that financial instability, but it's gone off with minimal issues, Nouriel. Can the Fed continue on its progress of QT, or will something make them stop?
Well, for the time being, of course, QT has not had a huge impact. Even if long rates have gone higher, they've gone higher in part because growth has been stronger than expected, but that could be also implicitly the effect of having a quantitative tightening occurring, the fact that other central banks like the BOJ will have to phase out their easy monetary policy can put higher pressure on long-term interest rates as well. If inflation stays higher for longer, that's going to also put upward pressure on short and long end of the yield curve. And the higher long rates are, the more the potential for some degree of financial stresses in the system.
One of the mega threats that comes in at number 5 on your chart list is stagflation.
Yeah.
By any measure, Europe is already there. So my question to you is this. I mean, they can't even call the top of rates. Lagarde did and Kazakh didn't over the weekend. How brutal a form of stagflation are we looking at in Europe, given history?
Well, you're absolutely right. I mean, in the US right now, growth is still positive and above potential. In the Eurozone, has been either negative or close to zero for the last 3 quarters. And the latest signals coming from Germany and the rest of the Eurozone suggest that the economy is going to be stagnating. At the same time, inflation is still way above target, not just in the Eurozone, but the other case of stagflation, of course, is the United Kingdom, where right now inflation is even higher than the Eurozone and economic activity is slowing down very sharply. So what Europe is facing a situation in which on one side economic activity is contracting, on the other side is inflation is too high. That's what the stagflationary scenario it is. And that's a dilemma for both the ECB and the Bank of England. On one side, the contracting economic activity will lead them to maybe stop at this point. On the other side, if inflation remains much higher than the target, they may have to hike much more. That's a big dilemma, especially for the Bank of England.
Hey, Rubini, but before we get to break, I do want to bring up one point. Last year, you predicted a long and ugly recession for the U.S. That would start last year, continue for this year. We haven't seen that yet. Did you get something wrong there? Is it recession denied or delayed?
Well, you know, most forecasters, including even the staff of the Fed, were expecting a recession. The good news that it doesn't look like we're going to have a real hard landing. Then the question is whether we're going to have a soft landing or a bumpy landing. Bumpy landing being maybe a short and shallow recession. And on that debate, we don't know yet. There are long and variable lags of monetary policy. The Fed might have to hike more. The credit issues might emerge as there is tightening of financial condition. Oil prices higher imply, on one side, higher inflation and lower economic activity, even in the United States. So I would say that whether we're going to have a true soft landing, rather a short and shallow recession, is still as an open question, even for the United States.
Nouriel, I'm trying to get the most underpriced risk out of you. From the tone of what you just said, the UK could be there. Confidence in the Bank of England is at a record low by their own survey. It's never been as low. How much are we underpricing what more Bailey and the Bank of England needs to do? How much more of a brutal stagflation scenario is it for the UK? Wrap it up.
Well, you're absolutely right. The problem is that the Bank of England right now is sending sort of dovish signal in a situation in which the policy rates are well above the Fed. but inflation is well above the United States. So what they should be doing is actually hiking rates all the way to at least 5.75. The signals are telling us right now is they're not sure whether they want even to hike more. If that happens, there could be a de-anchoring of inflation expectation. You could have a true stagflation.
Okay, the stagflation calls from Nouriel Roubini comes in at number 5 on his charts. He stays with the Bloomberg brief. That's the state of play, Danny, for now. Negotiations are at a standstill, quite literally like the traffic out there. The UAW calling the proposed 21% pay rise as a no-go. That's on offer to the auto workers right now. What would get them to green light the situation? And in search of bubbles, up next, Nouriel Roubini weighs in on the global AI frenzy. Plus, disappointment for Societe Generale. It cuts revenue and profitability forecasts. Underwhelming strategy update day for the new CEO on Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
What do you have for skincare for men in their 70s that have a lot of wrinkles? I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things, but maybe it'll be a little bit beyond skincare.
We're prepared to do whatever we have to do. So the membership is ready. The membership is fed up. We're fed up with falling behind. It's been decades of falling behind, and especially this past decade, in the most wealthiest times in the history of these companies. There is no excuse. These companies have made $250 billion in the last 10 years, $21 billion in the last 6 months alone, and our workers' wages and conditions have went backwards.
That was the United Auto Workers President Shawn Fain speaking on CBS on Sunday. The union rejected the car makers' latest offer of 21% pay rise as the strike against the big three U.S. auto workers entered its third full day. Still with us this morning is Nouriel Roubini. Nouriel, Hollywood's on strike. The auto workers are on strike. Europe has its form of angst. Is, again, going back to the underpriced risks, the tail risks, as it were, from mega threats over the next couple of years. For central banks, it's about wages. This is another example of where second-round effects are perhaps underpriced.
They're absolutely so. I mean, there's been a significant increase in income and wealth inequality. The share of labor in income has fallen. The share of capital has gone up. And now that the unemployment rate is much lower in the United States, but also in Europe, the workers have pricing power, and fiscal policies also during the COVID recession became pro-union, pro-workers, pro-wages, products were left behind. So I think we're going to see a meaningful amount of labor strife because inequality has been rising, and now labor has more power than the past. And that's going to be a source of wage inflation. That's going to keep a unit labor cost rising more than otherwise. And that implies that most likely inflation is going to be higher than 2%.
Now, look, AI is again on your mega threats. AI and job destruction, it comes in at number 8. What went through my mind when I was preparing to sit down and talk to you was about universal income. How quickly will that begin to be much more of a conscious conversation as AI accelerates? Or is there a considerable lag between AI innovation, NVIDIA booming, and the chip stocks booming, and universal income, real job destruction?
Well, the real job disruption is going to occur over time. There'll be a significant amount of permanent technological employment, not just among blue collars because of robotic automation, but especially among cognitive workers that are white collar. And then there'll be a reaction on what to do about it. The problem with universal basic income is a good idea, but if today you had to give, say, $1,000 to every American per month, only $12,000 a year, that's not much money. It would cost us today, with the current GDP growth, about 20% of GDP, so we cannot afford it. Of course, if over time AI leads to much higher productivity growth and much higher potential growth, we eventually will be able to afford UBI. But from a fiscal point of view, UBI currently is mission impossible. So there's a lot of talk about it, but it's going to take a significant amount of time until we see significant amounts of permanent technological employment, until that idea becomes politically and economically viable.
Nouriel, in the meantime, in a world where labor has negotiating power for higher wages, what does it say about specifically the American project of home shoring? Is it possible, if we're in a world where labor in the U.S. is all of a sudden more expensive?
Yeah, you're absolutely right. You know, even if there was, unquote, reshoring or home shoring, the new factories are going to be capital intensive, skill bias, and labor savings. So we're going to have factories with lots of robots and machines, but not that many workers. I think that the benefits are going to go more to some of the emerging markets where the friendshoring is going to occur. Some of their friends are allies in Asia, Mexico, and other parts of the world, because in those countries the cost of labor is lower, and therefore any type of reshoring or friendshoring is going to be labor intensive as opposed to being capital intensive. But the impact, of course, of reshoring on the U.S. Job market is going to be only very modest.
Okay, so then Sir Manus, go ahead. You take it from here.
No, jump in.
Well, I wanted to know, Nouriel, about that 2% inflation call. You said we're going to be above there because of these prolonged labor strikes, and then the pressure of the nearshoring. How long and how far above 2% do we stay? Is this a fundamental regime shift of inflation in which you're describing?
Yes, I've argued that the era of the great moderation of low inflation below 2% and stable growth is gone, and we're entering an area of what I call great stagflationary and financial instability. Higher inflation is going to be caused both by supply-side factors, deglobalization, geopolitical conflict, aging of population, restriction of migration, reshoring, global climate change, pandemics, cyber warfare, backlash against inequality, partial deglobalization. Those are all supply-side factors that reduce growth and increase the cost of production. And on the demand side, we live in a world in which there is so much private and public debt, and deficits are going to remain higher because we'll have to spend more against inequality, against climate change, to deal with pandemic, to deal with inequality coming from globalization and AI, and so on and so on. So spending will be higher, taxes are not going to rise as much, structural deficits will be higher. So either we crowd out growth or have debt crisis, or eventually we have to monetize it, and that's going to cause essentially inflation. So both on the supply side and the demand side, there are factors imply that 2% is at this point mission impossible, and the new normal may be somewhere between 3 and 4% for advanced economies, over time, of course, not overnight. So there are structural factors rather than cyclical that imply that inflation is going to be much higher for the longer term.
Nouriel? dig deep. We've got to get an optimistic call out of you before the end of this show. But hold that thought. Nouriel Roubini, our guest this morning, setting the tone. Coming up, it's been an underwhelming day for the update from the Soc Gen. The new CEO delivered his strategy, and to say it disappointed is a 10% blow on the stock right now. We discuss on Bloomberg.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
I've heard the market analysis.
We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations.
Let's check in what you need to know. A crisis-level valuation. All right, coming up next, we dig into some of Nouriel Roubini's bold calls. This is Bloomberg.
How did you feel when you said, would we get up at 5 o'clock? Did you look at the message and go, he's having a laugh, isn't he?
It's a bit brutal. So I went to sleep.
Listen,
there.
I know you're loyal to Tom and John and Lisa. I know that.
Oh, I was going to ask.
that given that we have this productivity enhancing technology that is AI, that has come off the back of this transformative communications network that's the internet, and we have a fundamental shift in the way the energy system is working, so there could be the ingredients of a pivot point of a kind that we've only seen a couple of times previously in history.
But let's ask what the driving forces will be. The world is propelled forward and has been for thousands of years by great power competition. That is the thing that drives innovation right now across the board. It is a competition which is intensifying between two superpowers, the United States and a communist-led superpower. Now, is this starting to sound familiar?
It does.
So what is really significant about this historical moment is that we are in the first inning, the early phase of Cold War II.
Right.
And that is going to drive all the things that we've talked about, and it will not necessarily drive these changes in directions that are benign. That the big technological advance of Cold War I was, of course, nuclear weapons. And the arms race with nuclear weapons was an extremely dangerous one that very nearly blew the world up, particularly in 1962, at the time of the Cuban Missile Crisis. Yeah. I don't believe for a minute that we can have a Cold War II without a similar risk.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Discussing all of that and much more this hour with Nouriel Roubini, a top economist who has a track record of predicting doom. Now, there's some doom in at least tech markets to end the day on Friday. It was all the mega cap stocks that got absolutely crushed. We're coming back, but ever so slowly. I mean, this is basically unchanged. We're up less than 0.1% on S&P 500 futures. It's less so in Europe. Things aren't looking great here. We're down about 0.6%. Manis, what is the thing dragging us down? It is SocGen. I'll tell you, this thing has been really volatilely trading. We're down about 8.8%. I checked it just moments ago. We were down 10%. It's a new strategic update from the new CEO there. They're cutting revenue. They're cutting profitability. A new dividend way of paying out to shareholders. That's concerning for some, too. BI says that SocGen right now trading at crisis-like levels, Manis.
Yeah, and that was probably one of the best interviews we ever did with when he was the head of the investment bank, which was, you know, bonuses for all my friends. They're going to be mega. Yeah. Now he's actually got to manage the business. In terms of cross-asset, taking from that sort of little wobble in the equity market, you saw tech draw down on Friday. But for us, as far as cross-assets are concerned, I'm really focused on the oil market. We're kissing 95, and I like what Halima Croft had to say, which was the strength, the musculature of this rise was something we could barely imagine. Prince Abdulaziz bin Salman, the head of the Saudi oil delegation, will talk today in Canada. What will he say that will drive the view of deficits higher? The hedges are long as you can be for 15 months. We're at a 15-month high in terms of the hedge fund exposure to the oil market. So kissing that $100 is not hard to do. Now, when it comes to euro-dollar, we were down for 9 weeks in a row. Stagflation. We've just had 30 minutes with Nouriel Roubini. Again, redefining what stagflation is in Europe. But the euro is down. By the way, they're loading up the longs on the dollar. Is that because of a potential shutdown? Is that because of stagflation and the lack of growth in Europe? Which then takes you squarely to the short end of the curve here in the States as we go into Fed on Wednesday. Now, this is where we need to really begin to understand what is higher for longer. What is the view from the dots? Will there be another hike in the dots this Wednesday? And will it show a number of cuts, 3-4 cuts next year? Because that is important. The differential between 3 and 4 is pretty immense in the market steepening, the bull steepening that's been going on. Short rates above 5% for the moment, Danny. But there we go. It is about stagflation. Who is wearing the worst shirt of all in terms of growth and inflation? And that's a big call, and that's the 2024 narrative.
Yeah, and look, we've been spending the past hour with Nouriel Roubini. If you've missed it, first of all, shame on you. But second of all, our great Bloomberg News team has already written up Nouriel Roubini's thoughts that he just shared with Manus and me about stagflation, about what you're talking about, Manus. What stuck out to me was Nouriel saying that the BOE should hike to 5.75%. Just get it done with, and with the dovish language, but that's needed in order to avoid stagflation. But that's not really what we're hearing from Andrew Bailey. We're hearing a BOE governor who has been talking about getting to the top of the mountain and what that mountain might look like.
Absolutely, and I think when it comes to the stagflation narrative, the other thing that we took away from Nouriel was about the UK. Maybe they don't have the wherewithal to get to the 5.75%. I encourage everybody, go back and look at Sky TV yesterday in the United Kingdom. They played out a piece from the former Bank of England governor, Mark Carney. Surreal what he said, which was Liz Truss and her cohorts tried to deliver Singapore on Thames. What they delivered was Argentina on Thames. And that is a rebuke from a former central banker. Sterling under pressure, cable 123.95. When I left the Middle East last week, I was thinking about switching money. We're trading up at around 125. The pressure on sterling is tough at the moment. Danny.
Manus, you live in America. You're not allowed to be plugging
God
Sky
bless
News
America.
anymore.
I have arrived. I have arrived, the promised land.
His viewing taste might not have changed yet. I'm sure those will catch up. We'll get you watching the Kardashians in no time, Manus. All right, let's shift gears and talk about Wall Street. Strategists there have been largely wrong about this year's stock rally, but they're starting to face their mistakes. Strategists at SocGen, Piper Sandler, BNP Paribas, they're all raising their 2023 calls. Some, of course, are still bearish, Morgan Stanley's Mike Wilson being among them. Let's get back to our conversation with Nouriel Roubini, CEO of Roubini Macro Associates, who, of course, is the author of Mega Threats, 10 Dangerous Trends That Imperil Our Future and How to Survive Them. All right, Nouriel, last time you were on Bloomberg TV, you talked about a 10% decline in equities. We're going to switch up the pace. Fast answer, rapid fire here. I want to get to that call. Tell me where you land on stocks at this moment. Would you want to be shorting or going long American stocks?
For the rest of the year, I will be shorting U.S. stocks.
All right, and is that a 10% decline? Is that still about where you think we could land?
It's highly possible, given what's happening in the U.S. and the global economy, and rising oil prices and inflation being still sticky, and the Fed and other central banks not being done yet.
All right, is that a call just for American stocks, Nouriel, or globally, are you looking dour on equities?
Well, in the rest of the world, it's even worse than the United States. In the U.S., you might have a bumpy landing, but in the Eurozone and UK, we're talking about inflation and recession, stagflation. China is slowing down sharply, so the rest of the world is even worse than the United States, I would say, in relative terms.
I'm going to get a bullish call out of you. When do we hit $100 in oil, will we?
I don't know if that's bullish. Might be bullish for the oil market. It's not bullish for inflation. It's not bullish for growth. It'll be pretty bad. It's another stagflationary shock. You know, when oil prices go higher because there is stronger demand, that's consistent with economic activity being stronger. But if it's a negative supply shock because Saudi and others are cutting supply, that causes a greater inflation, lower growth throughout the world. So that's actually bad for the global economy.
Where do you see oil going to, Nouriel? Where's the upside on it?
Well, it depends, you know, it depends on what happens on the supply side. If the OPEC Plus keeps on restricting supply, oil prices can go higher. But I would say that if global demand is going to soften because you have Europe in a recession, China slowing down, even the US are going to slow down, eventually probably there'll be some correction to these oil prices on the demand side.
Nouriel, I'm going to try again for a bullish call. I know Manus was trying to do it. It's our first show. We got to be positive about something, Nouriel. Yeah. Take me to the FX world. What currency pair would you want to be long right now?
Well, for the time being, I would say the dollar, because in relative growth terms, the US is going to do better than Europe and rest of the world. But I would say that because of that growth differential and because inflation might be falling in the US, probably the Fed might be the first central bank to eventually fully pause and then start cutting rates. And that's going to imply that, say, by next year, the dollar might weaken because of the relative interest rate differential expectation between United States, Europe, and what's going to happen in Japan, where they have to phase out the YCC and normalize policy rate. So in the short run is a bullish dollar call, but over the medium term, actually, there are factors that are going to lead to a weakening of the US dollar.
And then in that longer term too, then, is it a long yen call? What do you need to see also from the BOJ to get to that place?
Well, I would say that by the end of the year, they might fully phase out the yield curve control. They are already talking also about phasing out the negative interest rate policies. This is the only advanced economies right now is still negative policy rates, and as gradually short rates go higher, long rates go higher, that should be strengthening the yen that has been quite weak, of course, because of the differential in monetary policy between the BOJ and the rest of the advanced economies.
Let's just pivot briefly to the Chinese market. Some people are saying we've hit peak pessimism on China from an economic point of view. That's got a consequence for the yuan. Your call on China and yuan?
Well, the problems of China are not cyclical. They're more structural. Potential growth used to be 10% and down to 5%. Today probably is no better than between 3 to 4% because you have massive aging of population. You have huge amounts of private and public debt. You have a overhang of real estate. You have a state capitalism galore under Xi Jinping. The sentiment of the private sector, households, and the private corporate sector is really foul because of the policies of China. You have geopolitics going to restrict both inflows of FDI and exports by China, and they're doing everything wrong in terms of policy. So I would say they'll be lucky if they have 4% growth over the medium term. 3% is more likely. Therefore, the issue of China is not just cyclically that the economy is weak, but structurally is weak.
We're going to spend tomorrow on private equity and credit and debt. So let's get your call in terms of, do you want to be longer of bonds and duration relative to debt and credit, let's say?
Well, I would say that high yield spreads are too low in a world in which there's going to be a slowdown of growth, a bumpy landing, stagflation. Eventually, credit risk is going to rise given amounts of private and public debt. So spreads are so low that they can widen from current levels. And on bonds, I would say right now people expect central banks to cut rate aggressively. I don't think that's going to happen. Inflation may surprise on this upside, both in the short term and long term. And there are structural reasons why the risk premia for bonds should be higher, high levels of private and public debt. So I think markets are, again, too optimistic on credit and also on bond markets.
All right, Nouriel, you're going to stick around with us. Much more to discuss. Nouriel Roubini there. Now, coming up with global issues piling up, the UN is struggling to keep pace. Will it be able to redeem itself as world leaders gather this week for the General Assembly? This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg Brief. You're looking live at the Principal Room. Coming up later today, an interview with Chevron CEO Michael Wirth. That's at 11:15 a.m. Eastern, 4:15 p.m. in London. This is Bloomberg.
This is Bloomberg Brief. I'm Manus Cranny in New York with Danny Berger at London HQ. Well, the leaders from around the world are descending right here on Midtown in Manhattan for the UN General Assembly meetings. Bloomberg's Jen Zabazaja is right here in town. Jennifer, good to see you this morning. Up early, radiant. You've got a busy week. What is on your agenda for UN?
Yeah, that's right, Manus. Good morning to you. I mean, it's really going to be the first UN fully in person since the pandemic. So it is significant, but it's also significant if we take a look at the confluence of issues that these leaders are facing, and there's no shortage of them. I mean, if we talk about, there's climate catastrophes that are increasing. There's also the effects of the war in Ukraine. There's also the leftover spill from the pandemic. And not to mention a number of geopolitical tensions, including a number of coups in the part of the world that I cover. So the leaders have a number of issues to tackle. The question is now, as Danny sort of alluded to before, is whether or not the UN can actually keep up with this changing world. And especially when you look at the leaders who are going to be here this week, there's a lot of questions about whether or not they actually can do that. U.S. President Joe Biden is going to be the only leader from the UN Security Council who has the veto power, who's actually there. There's a number of leaders, as you can see, who are not going to be there. And so if this is really the multilateral forum where a number of developing nations are meant to express their grievances to developed nations about what they need and what they're not getting, the question will be whether or not we'll actually see that happening and we'll actually see some changes and some real solutions to a lot of the challenges that we're seeing this week. So a lot to pay attention to. And of course, we'll hear from President Biden. We'll see a number of bilaterals happening, but a lot on the agenda this week.
Okay, very interesting to see who's not there, Jen. I'm sure we'll catch up later in the day. Jennifer Zabazaja covering the UN General Assembly meetings. Our guest this morning is Nouriel Roubini. Fascinating to see who's not there. I mean, the real power, apart from the United States of America, the UK is not there, she's not there, Putin's not there, Modi is not there. How disemboweled is multilateralism, or is that a misconception?
No, we live in a world in which, because of the geopolitical divide between, on one side, China and other revisionist powers like Russia, Iran, and North Korea, and on the other side, the US and the West, we have a world in which there is a geopolitical depression that's leading to a fragmentation of the global economy, de-risking, if not decoupling. There is protectionism. There are going to be restrictions to trade in goods, in services, in the movement of capital, labor, data, information, technology. And that's going to be also stagflationary. We're going to have just in case rather than just in time, global supply chains, emphasis on security rather than economic efficiency, reshoring and friendshoring rather than offshoring. All these things tend to reduce potential growth, increase the cost of production, and there are stagflationary forces. We're going to have balkanization of global supply chains. So it's a very different world where geopolitics has economic and financial consequences.
We already have war waged by Russia on Ukraine. I want to bring you a Bloomberg opinion piece which talks about the coalescing of Putin and Kim Jong-un, and this is what they had to say. This is about North Korea is a dangerous thing. The idea of a nuclear conflict between the countries that are united against the US and its allies isn't some distant possibility. It's a more real and plausible scenario seen in decades. Of course, we've just seen Kim Jong-un and Putin meet over the past couple of days. I'm not asking you to call nuclear war. What I am asking you is about how much more disruptive our geopolitical landscape is with Taiwan, with China, with the US, with this coalescing of powers against the US.
Well, the geopolitical depression is going to get worse. As you pointed out, there is already a hot war with the brutal Russian invasion of Ukraine. This war is going to continue, could get uglier, could eventually, potentially even involve NATO, could become non-conventional. The Cold War between US and China is becoming colder, and now people are saying it's only a matter of when, not whether, there's going to be eventually conflict on the issue of Taiwan. Iran has reached the point in which they are enriching uranium, and they may decide to go and build a bomb. That's going to be essentially a red flag for Israel. There could be an attack against Iran. And the little dictator in Pyongyang keeps on sending rockets on the sea of Japan and South Korea, and that's also a source of tension. So all these revisionist powers, either they're nuclear powers, or like in the case of Iran, they become nuclear, and therefore these tensions are going to imply at least economic fragmentation, and eventually could be even more dangerous scenarios.
Nouriel, I want to be clear. Are all those things you laid out inevitable, or is there any hope, again, for any of the risks that you just laid out, that it can be avoided?
Well, in my book about mega threats, I talk about these threats and also the solution for each and one of them. But the solution always implies cost and short-term sacrifices for the common good domestically and globally over the medium and long term. And whether you are in a democracy where, because of election, we tend to essentially kick the can down the road, but even in essentially authoritarian regimes, look what's happening in China, where you have essentially policies that are wrong because even autocrats are not able to do the right thing. We live in a world in which there is lack of global leadership at the national and the global level, and therefore these festering problems that are mega threats probably going to get worse rather than getting better. We need actually more governance at the global level because all these problems are global. Climate change, pandemic, financial economic stability, trade liberalization, and even global security. But in a world of geopolitical division, the ability and willingness to cooperate on these things is less than the past, and therefore that geopolitical fragmentation and economic and financial consequences become over time more severe and more difficult. So we need cooperation, but we're not going to have global cooperation, unfortunately.
I want to take one of your other mega threats, Nouriel, AI, and apply it to this too. We're about to enter an election cycle for many nations, for America, likely where I am here in the UK too. Have we fully grasped what AI and the age of misinformation will do, the impact it will have in this election cycle?
That's one of the very serious risks of AI. It's going to be much more easy to do deep fake, misinformation, disinformation. That was already quite easy in 2016 and 2020, but in 2024 it's going to become much worse. And the enemies of the United States, or the rivals, whether it's Russia, North Korea, China, Iran, are going to use these tools and other ones as a way of spreading actually doubt and sow divisions in a world where already the United States is very partisan. They're going to try to create more partisanship because from a military point of view, they cannot challenge the US yet with the strongest military power, so they have to use asymmetric warfare that implies cyber warfare as a way of dividing US and fragmenting us in a way that's going to be weakening the United States and the ability of the US to project power around the world. So it's a huge risk for next year.
Okay, Nouriel, thank you very much. Uplifting thought to end the 50-minute conversation, but well done. I think we almost got a smile out of Nouriel there this morning. Nouriel, thank you very much. Great to have you with us on our inaugural show. Your contribution, as always, great to have. Coming up on the show with Danny and I, some market moving events through the week. The direction of currencies will be defined by the Fed, the BOJ, and the BOE, the G3. Good morning.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year, and so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Now let's get a quick look at what's ahead for you this week. Global leaders gather in New York for the week-long UN General Assembly. That kicks off on Tuesday. A lot to watch out for there. Plus, we're going to get the latest inflation print out of the Eurozone on Tuesday. Economists estimate that the amount of price increases will be the same as the prior month. But that's not all. It is a central bank bonanza. We're going to get rate decisions from the Fed on Wednesday, the BOE on Thursday, and then the BOJ on Friday. Manus, how is that for a launch week? Is that enough to keep us going? I think so.
Well, I mean, you know deep down that I've just got radial envy. I mean, there you are, your technology and this slow continental drift behind you. You know, well done. Now I know where the budget for this show went to. It went to London. Hey?
I can't take the credit for it. It's our amazing director, but sorry, Manus. I mean, again, come visit me. You can use him.
I got to say, big shout out to everybody. Well done, everybody. Huge team effort to put this together on the road, day one, and nobody fell over. But I tell you what did happen. How to lose friends and alienate people. That is what the SocGen new CEO, who we both know very, very well, Sławomir Krupa, this is what he did. Underwhelmed the market in terms of profit guidance, cost cuts, and they tanked the stock, Danny, down $2 billion in market cap. He's cutting the revenue target to flat to 2%. It's going to cost a transformation cost of €1 billion. So, Danny, this is the Toby Young narrative of equities, which is how to lose friends and alienate an entire market.
Yeah, Manus, I was just looking up when we last spoke to Sławomir Krupa. Again, then he was head of the investment bank. Now he's the CEO. It was February of 2022, and he was telling us that massive bonuses were on the way. Wow, what a different world we live in, again, from just over a little bit more than a year ago.
Well, how the world changes. They didn't let him back on the telly again when he went, big bonuses for all my friends. Where do you want to be in a stagflationary environment? Where do you want to be if the government shuts down here in the United States? Where do you want to be? Well, we know where the hedge funds want to be. They want to be long the dollar. They've pivoted. They've just tilted on the dollar. The first time we've seen a big bullish call since March of this year. Is that dollar strength, or is that a drop in the euro longs, Danny?
Yeah, but the thing that could set the cat amongst the dollar bull pigeons is the BOJ on Friday. Do they abandon negative rates? Will we see a huge surge into the dollar, into the yen, out of the dollar, Manus?
There you go, dollar yen. Look, it's going to be a monster week for rates, a monster week for FX. Good morning from New York.
what do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
The markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
We've yet to see the full effects of the previous tightening come through into the real economy.
We have structural imbalances here in the U.S. that no one wants to deal with in Washington.
The bigger concern would be that things get unruly in China.
I think the Fed is going to be paying very close attention to the path of energy prices ahead.
The Fed will do what we all expect it to do, which is to pause and basically indicate they're data dependent.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From the City of London for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. The only reason we're on tour, it's Bramo's birthday. Happy birthday, Bramo.
Thank you.
That's a cute, isn't it?
Well,
Happy birthday,
thank
Lisa.
you. I appreciate it.
What else are we doing on the birthday tour?
Well, I'm going to go to Camden this afternoon, and
Okay, nice.
maybe we'll, a Tots game, I
Are
think,
you
is probably
going
in the
to have
works.
hot brown water with the king?
Hot brown water.
Brown
You're really
water.
you're appreciating yourself.
Hot brown water with the king.
What is
4
hot brown
p.m.
water?
It's a proper hot water.
Tea with
Okay.
crumpets.
Okay, let's restart. Live from the City of London this morning. Good morning, good morning. Here all week for you with some fantastic guests as well. Let's start with equity futures on the S&P 500. Positive here by 0.1% on the S&P. TK, not talked about enough this morning at all. We are very, very close to cycle highs on a 10-year this morning. 434 in America.
I think it's completely underplayed the market. You're dead on. I look at the 10-year real yield just as the benchmark, buttressed right up against 2%. Anything through 2.02, 2.03 would be something new. But you're absolutely right. This is underplayed right now, and that's going to change abruptly as we go. There's a meeting on Wednesday, I believe.
There is, and there's another meeting on Thursday at the Bank of England. There's another meeting
Yeah.
on Friday at the BOJ. TK, your favourite line, that phrase from the Disney movie, A Whole New World?
It's a whole new world
A whole new
after all.
world.
It
A whole
is.
new world. When 21% price wage gains don't make
Yeah.
it happen, don't get it done.
For the American audience, I mean, it's stunning to land here, drop off the Gulf Stream at Heathrow and come in to a strike of junior doctors in 75 years, much like UAW, but in 75 years, you've got NHS strikes here over the shocking pay these guys make. Residents, they're making next to nothing here.
Compared to the United States.
Oh, it's amazing. The
Well, auto
difference.
workers as
Yeah.
well, Bramo. Let's go through the numbers. Starting at 40%, down to 36 at UAW. Stellantis say, okay, let's go. Let's go up through 20. And nothing. Tumbleweed. UAW does not want to play at all.
Which raises a question, what will get it done? It's unclear. If it's not 20, if it's not 21%, if it's not 22%, if it's not extra sick days, if it's not anything else, is it just the full thing or else nothing? And this does tie together with the angst that you're seeing in the bond market. Basically, people coming out and saying, this is going to keep inflation present for
Right.
a longer period of time.
Well, what's Mari Barra do? I thought her conversation with David Weston was really apt. She was pretty tough about it. And all, did she dial 1-800-MUSTANG and, call up Ford and say, let's go? What are we going to do? I don't sense any of that here as we begin the week.
Jim Farley-Ford, we've never seen anything like this. Dazed and confused. Lisa, we talked about the strategy coming into this ahead of the deadline. We were talking about how they might target one over the other. Traditionally, that's the playbook. Mr. Fain has not followed this playbook whatsoever.
And that was by design. That wasn't necessarily a bug. It was a feature of this entire program. It was to surprise. It was to shock and awe, to try to claw back some of the concessions that were made in the aftermath of the financial crisis and ahead of artificial intelligence and key changes technologically.
To me, so much of this, including the tension in the United Kingdom, is get it while we can, because if you lock in a disinflationary tendency, as many people suggest, you better get it while you can. Do you like my bow tie?
It's beautiful. What does it represent?
It's a Ferrari bow tie. Yeah, for those of you on radio,
nice.
It's like very Carlos Sainz, you know.
Okay. You want to talk F1 or move on?
No, we'll move on.
Okay, good. I thought we were going to talk Formula One for a moment. Thank you, Ferrari, over the weekend. Let's start with the price action. Equity futures here positive by 0.1%, going into the central banking triple header this week. Federal Reserve on Wednesday. On Thursday, some Bank of England action. On Friday, the BOJ. Looking at this bond market, Bramo, I think we've got to talk about it again. 434 is so close to cycle highs, and I cannot believe waking up this morning it's hardly been talked about, with crude near new highs for 2023 alongside it.
And driven by real yields that are bumping up just a hair away from 2% at a time where people are gaming out. What does this mean longer term? Feeding into this argument, 10 a.m., and I think this is really important to watch, Saudi Energy Minister Prince Abdulaziz bin Salman is going to be speaking at the World Petroleum Congress in Calgary. I am so curious what he says about how much they're going to prolong their production cuts at a time where Brent crude is bumping up against $95 a barrel. Meanwhile, today, the UN General Assembly is holding its 78th annual session this week. Of note today, Vice President of China, Han Zheng, is meeting with Secretary of State Antony Blinken on the sidelines. Very curious about this, which came together quickly and quietly, especially in light of some of the tensions that have been percolating between both nations and the European leaders and China as well. And today, kicking off a week of the monthly housing data dump, 10 a.m. we get the U.S. NAHB Housing Market Index. Housing affordability is the most negative, the worst it has been in the history of this series going back to 1986 by the National Realty Association. And I'm wondering at what point you start seeing that feeding into some of this price-wage spiral. Rents are getting really expensive.
Big time.
Home prices are not affordable. How do people deal with that?
As we're in London, should we share some local knowledge?
I think so.
Rents in London up more than 17% year over year. 17.1%. Now, compare that to New York. We were talking about Manhattan rents being up something like more than 7% year over year. Bravo, 17% year on year. That is just absolutely phenomenal for all the wrong reasons.
And you wonder why people are striking. And you wonder why people are saying we got to get paid more. It is staring at them in their face when they see their rent increase, when they see their bill at the grocery store, when they see their petrol bills. See, I'm adapting.
Petrol. Do you like that? It was nice.
I was just like, you know, I'd like to be able to.
We got this. Are you bringing this back to New York? It's just petrol while we're here.
Well, while we're here.
Gasoline.
I think she's got a British accent going.
By the end of the week.
Yeah. I'm not Madonna.
Give Bramo till Friday.
Jeff Yu and
Digs at Madonna.
No,
Sorry for that, Lisa. No. Jeff Yu joins us now, Senior Market Strategist at BNY Mellon. Good morning, Jeff.
Got a British accent.
It's good to see you. Yields at 5% at the front end, pushing cycle highs on a 10-year. Dare I say it, is this the new normal? Are we getting comfortable with this?
Well, let's go back to Tom's point about real yields, okay? You can deflate via CPI, headline CPI. What if we deflate nominal yields by wage gains or potential wage gains? So then if you take the 20% or between 20 and 40% real wages, nominal wage gains, if realized, then real yields actually are very, very negative still. And then central banks have to catch up. So there's a risk here, going back to your point about a wage price spiral that isn't going away anytime soon.
What is the x-axis on real yield? So here we are at 2%. I've done some fancy math. I get to 2.20. Maybe I'm still here at 2%. Whatever it is, there's a length of this new real yield. Where's the tension point out into next year?
So basically, you have to identify where potential GDP growth is, medium to longer term growth in the US. If that's a headline number, nominal number, 3 to 4%, then find your inflation target. Then if it's still 2%, right, then real yields, you still need to get to 2 to 3. Right.
To go nerdy on a Monday, R minus G, are we at a risk here where the interest rate becomes less than the small g, as Blanchard and Stiglitz, among others, worry about?
I'm glad you brought up Blanchard because I want to bring up another paper between him and Chair Bernanke.
Yes,
when does this become a problem?
Such a nerd fest over on the port side of the desk.
favorite part of the morning. In terms of wages versus price spiral, and with the oil prices going where they are right now, you get a price spiral according to that paper when labour markets are tight. Yeah. So here are the unions making the gamble or the determination in manufacturing labour markets are still very tight right now in the US.
Which raises a question, is this signal or noise? Because this is, yes, it is now tight. Although on the margins, you're seeing signs that you are getting some sort of labour market softening. Right. Is this the last gasp, as John was asking, of labour market power? Or is this something else that does have a stickier nature?
I'd say on a broader basis, this does feel like a last gasp if I look at things globally. But on the other hand, you know, I'm an FX guy at the end of the day. Relative, it's all about the relative differentials. I think US labour markets tighter compared to what we have in Europe right now. So on that note alone, probably Labour has more bargaining power in the US compared to in Europe.
Does that mean dollar weakness?
I would say, you know, short term, you know, dollar strength, you know, that's still going to be in play because that puts the Fed on a more vigilant footing, you know, to borrow an ECB phrase. But, you know, net, I think that pretty much that is in the price right now. So let's see where we're going to be.
Very cliche of you, Jeff. Let's talk about Powell on Wednesday. On Wednesday, we get a set of projections. Yep. Most people assume that for 2023, when we look at revised growth figures, they're going up. Yep. When we look at revised inflation figures, they're going down. What does 2024 look like for you and the team?
Still 2024, it's less about are they going to hike further. It's more about, you know, how long do US rates stay where they are. And that is, you know, what the BOJ will be looking at. And what, so you didn't mention Central Bank of Brazil, Central Bank of Turkey, and the Central Bank of South Africa, the Swiss, they're all deciding. And when they look at their nominal effective exchange rates, they'll all be looking at the Fed. How long can the Fed's projection keep the dollar strong? And then they'll have to calibrate their own forecasts accordingly.
Is that dollar problem bigger in Europe right now for you than EM?
I think that dollar problem is bigger in Europe because EM across the board, if you look at Brazil, for example, much higher real rates. So they've got the buffer, Europe does not.
Georgieva surprised us with a low 5-year growth view. Suddenly, oil 94. For Jeff, where is the price of Brent that's a tip point that really accentuates that global slowdown?
Let's look at the individual markets. For example, China's at a slowdown already, no matter what China, unless you're looking at a real re-acceleration in China, which is not my base case, to 5 or 6%, then you get into a demand issue on top of a supply issue. That becomes a problem globally, and then that could be a tipping point. But right now, if it's just the US alone, and given US energy independence, I think it's much more manageable.
I'm glad you mentioned China. The Wall Street Journal had this big expose. China might be weaker than you think, and Tafak has talked about focusing on the housing market. Other people have said, including Leland Miller of the China Beige Book, that from a U.S. perspective, this is what people want to see, but it's not actually what's happening on the ground, that there's actually a great deal of strength. Having been in China a couple of times recently, what's your view?
So domestically, I thought consumption was firm. So I was there about 3 weeks ago. You know, people were spending. You know, some of the key tourist sites, you know, like in Xi'an, the Terracotta Warriors, you know, was basically, you know, several rows behind before you could actually, you know, see the soldiers there. But then on the way out, look at Beijing Airport. You know, just, you know, barely any international flights, you know, coming out. So that higher ticket consumption items, I think, you know, that's a bit more of a problem at this point. Going back to the real estate market, you know, there's close linkages, you know, to the financial system in China. Stabilizing the real estate market means stabilizing the financial system, especially the trust and framework, shadow banking, you know, for example. So, you know, that's where I think that they are doing the right thing. But ultimately, how much more downside can you price in relative pricing? I think it's very limited.
Do you partition China into domestic balance sheet challenges, even out to Chengdu, or do you drag that into the more international analysis of renminbi and the rest? Do you partition or not?
So I think at this point, China's pretty much self-financed. We look at our own flow data. International financing for China's growth is very, very limited right now. So it's about domestic financial stability.
I agree.
And then the transmission is, if things, you know, go awry, can that drag down international growth further?
We've got to squeeze this in, Jeff. We're in Europe. There is an EV battle taking place. And to a greater extent, I think the transition to EVs is at the epicenter, the heart of this conversation with UAW and the Detroit 3 at the moment. Are we heading towards just massive tariffs for auto imports in places like Europe?
If you asked me 2 weeks ago, I would have said no, but I think something changed at the Munich Auto Show.
What do you think changed?
I think for the first time in 3 or 4 years, Chinese came back and European manufacturers looked at how far they were behind, not just in terms of cars, battery technology, and realized this is much more pressing than we thought, and you saw the reaction.
German manufacturers are scared of what's coming out of China.
Absolutely. And China saw this in advance. That's why they want to build in Hungary, you know, battery factories, and they want to build assembly plants in France as well. But even then, with that kind of cooperative approach, you're seeing the backlash already, and then you're seeing the backlash from Beijing. So this is going to get interesting.
Now, this is only one industry, but do you think there's broader things at play here that ultimately influence things like flows that contribute to calls in foreign exchange?
I think medium to longer term, let's look at the chip industry as well. That's going to feature heavily in terms of flows into Asia, into Europe. But the importance of employment, especially in Germany, and also that Eastern Europe that feeds into the German supply chain. I think this is, and politically speaking, this is absolutely going to be central to Europe.
Jeff, this was fantastic. Great to kick off the week with you here in London. Jeff, you there?
My pleasure.
Of BNY Mellon. Bramo, I'm with Jeff. I think you are too. Something did change on this front in the last couple of weeks.
And we had reports that some of the auto manufacturers in Germany were shocked at how much further ahead they are. Not just that, but have more access to the lithium underpinning this because they own that market. So at a certain point, if you can't compete, you regulate.
Well, it's not just tech, is it? It's not just the supply chain. It's cost.
Exactly.
It's cost.
Yeah.
And that's why I think these negotiations with the Detroit 3 and UAW just get bigger and bigger. When you start seeing 20% getting declined, how do they compete with Chinese EVs?
And this is what they're saying. How are we expected to remain profitable? How do we survive this if we're trying to compete with that? And the UAW said, figure it out because we don't want to lose our jobs.
Big story for us this week. The other one, of course, it is Bramo's birthday week. With us all week in London, Andrew Balls of PIMCO is coming up in the next hour. Live from London, good morning.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television. How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Stellantis said they've offered 21%. What are you expecting out of tomorrow's negotiation with them? That seems forward movement.
We've asked for 40% pay increases, and the reason we asked for 40% pay increases is because in the last 4 years alone, the CEO pay went up 40%.
So 21% is a no-go for you?
That's definitely a no-go, and we've made that very clear to the companies.
Sean Fain, UAW president, speaking on CBS. We're living in a world where 20% wage increases do not get it done. And a difficult moment for the CEOs of Detroit's big three, GM, Ford, Stellantis. Lisa, how do you respond to this? When a CEO pay goes up 40% and they turn around and say, we're offering 20, you say you got 40, why shouldn't we? What does the CEO say?
The CEO says you're going to put us out of business, which is what they're trying to say, which is the reason why Ford came out last week with layoffs at a certain plant that was affected. So at what point does that translate at a time where they're going to be layoffs anyway? And they're trying to get the little power they have remaining before there are some pretty massive changes.
Obvious comeback as a journalist to that question then, TK, is ultimately if 40% pay increases mean you face existential risk, why are you getting one?
Well, there's almost existential no. It's going to be interesting to see what the auto companies say. What I saw was a preponderance of pseudo-engineering analysis about putting an internal combustion engine together versus an EV. And there's some real stark differences there. There's some very good work on it this weekend. My answer is, so what? This is a cultural statement, which is simply, we sacrificed into your bankruptcies. Good morning, Dearborn. Ford, you didn't go bankrupt. And with that sacrifice, we need to get, what, some payback? I think that's where we're heading.
Question of the week, Tom. How long a visit will it take to have TK and Bramo pronouncing aluminium correctly? Never mind petrol,
but
diesel.
we're still going to do copper out of
Lisa?
Chicago.
Well, it just depends on a will. I mean, it's not sort of an incapability. It's just aluminum sounds better.
It's not about ability, it's about willingness. Okay. Equity futures on the S&P, totally unchanged. We're going nowhere. Looking at the bond market with yields a little bit higher by a single basis point. 434.45, very close to cycle highs. Looking at crude through 91 on WTI. We're talking about new highs for 2023. And a euro weak for 9 consecutive weeks at a close last week. The euro this morning, slightly stronger, Tom, 106.71.
Sterling weaker too. There just wasn't a bid to sterling off the weekend, Friday through this morning, breaking through 124, and back at a 124 level right now. But John, sterling needs a bid too.
Coming up to the anniversary of the Liz Truss budget here in the United Kingdom.
Getting some press.
Lots of fun and games. Is that why we're here?
No, but it's getting. Look, I got my bow tie tied like.
Did you see what a certain former governor of the Bank of England, Mr. Carney, said?
I saw that.
Some of that,
on the channel.
Yeah, that it was not Singapore on Thames, it was Argentina on the channel.
I read every word of that.
Yeah,
that was before.
What did you make of that address?
I thought it was very carefully worded.
Okay.
I thought that I read the entire address, and I thought it was a very careful statement. And, they'll move forward in the debate, but even more important, Everton lost to Arsenal. So
you watched that game?
I had to watch it. Governor Carney told me I had to.
Okay, because he's an Everton fan.
Yeah.
I did not know that,
I
but there we
survived
go.
it, to be honest. Right now, we're going to survive American politics. Gregory Valliere briefs us this morning. Chief U.S. policy strategist at AGF. Greg, in the Washington Post, they talk about 5 ideological factions of the Republican Party. I didn't know that. Do you actually buy the idea, given labor unrest in America, given a possible government shutdown, that Mr. McCarthy's dealing with 5 ideological factions?
Oh, at least. Yeah, it's quite a spectacle right now. He's on really thin ice, Tom. I don't think he can get a deal before the October 1 deadline. So we do have a shutdown. I call it shutdown light, because it's not going to be the end of the world. We're not going to kill Social Security and Medicare benefits. But if you want to go to a national park, you're out of luck. And I think the shutdown is going to last for quite a while.
Is there a shutdown in Detroit? What I find stark is the imagery and the great coverage by Bloomberg on this. I see them picketing, and there's like 7 people out front. It looks like a lineup at Denny's waiting to get in. I mean, is this like a real strike of labor like you and I remember? Or is it sort of kind of like pretend?
Yeah, it's not like what we remember, that everybody went out and you didn't selectively target factories. But I think there have been some sign of progress. I think Ford has been the most conciliatory. And I think the elephant in the room, obviously, is Joe Biden. I think Biden knows that Michigan has 16 electoral votes. And I think Biden will be influential in the final agreement.
What will that entail? Do we have a sense of what it will take to get it done and what that means for the viability of auto manufacturers that have traditionally added to the GDP and really fostered a lot of strength in the Midwest?
Yeah, I think it will have to be close to 30% in wages. 40% is out of the question, but I think the number will creep up. They may go back to more like defined pensions. They may have less than a 40-hour work week. It will be generous, and it will add to the perception that wages are sticky for the Federal Reserve. I think sticky wages are going to be around for quite a while.
Does this pressure, just sort of uniting the two ideas, does this pressure lawmakers to try to get a budget deal done just to avoid the extra hit on that front, especially at a time where there might be some agreement on things like border control between the Republicans and Democrats?
I tell you, Lisa, these people are on a different planet from you and me. They are fighting these parochial fights knowing they're going to lose. I mean, it's quite clear that this compromise over the weekend would never make it through the Senate. I'm not even sure it would make it through the House. So we're going to go through this exercise. And sadly, I think this drags on right into the holiday season, maybe after the holiday season, before we get a deal.
Greg, I got to turn the script. Once again, over the weekend, lots of discussion about the president's age. I think all of our listeners and viewers are sort of exhausted by the debate. But I want to know the Valier timeline to where I get an LBJ announcement like March of 1968. You and I were sitting on the couch watching the Bruins lose when that happened. How do we get Joe Biden out to where LBJ was in March of 68?
I don't think he realizes there's a problem. And more Democrats I talk to, almost all of them, as a matter of fact, say they would like to see Biden step down. Two problems. Number one, he is delusional and he doesn't think there is a problem. Number two, there is no logical successor. That's the problem for the party.
Do the polls scream, Greg, that there's a problem?
Absolutely. I mean, about 70% of Democrats say they would prefer a different nominee. I mean, that I've never seen a gap like that. So you could have more pressure. You know, the other thing, guys, I should mention is that filing deadlines are fast approaching. By late October, early November, it's too late to file. So any talk about some last-minute rescue for the party, I think, is unwarranted.
Greg, before you go, have you heard about that missing F-35? Have you read the story on that?
Missing what?
F-35 fighter jet gone missing.
In the Carolinas.
Greg, what on earth is going on? How does the military lose an F-35?
I know, it's quite a story. And yeah, I think it's going to get bigger.
Greg Valier of AGF, thank you, sir. If you don't know what I'm talking about, I'll share the Washington Post story with you.
Greg, thanks.
It reads as follows. An advanced F-35 Lightning II jet went down somewhere near Joint Base Charleston on Sunday afternoon. And the pilot ejected safely and was in stable condition, the base said. But the problem is that the responders aren't sure where the plane ended up. Believe it or not, the jet's transponder, which usually helps locate the aircraft, was not working for some reason that we haven't yet determined. So we're sitting here, and somewhere, someplace, there's an F-35 that the military can't find?
It raises questions about whether someone interfered with its signals and then maybe took it somewhere else. Well, I mean, what else can you really start to question where things went?
I would question the moment I saw the news, to John's good point, John, I'm glad you brought it up, the conspiracy theorist people will click in here with a vengeance. You know, there'll be an investigation. Obviously, somebody screwed up big time. That's a piece of hardware.
What blows my mind is that at some point on Sunday, there was an F-35 just sort of flying through the sky on autopilot without a pilot. Like that's
it doesn't make any sense.
That makes no sense at all.
Correct.
It's incredible. Okay, we'll see what happens with that story.
I think it's really interesting too.
I'm pleased you're on the same page. Madeline Jones of Oaktree is coming up. Before we get there, let's check out the price action for you. Equities on the S&P 500 up by 0.1%, just a little bit higher, and the bond market yields a touch higher as well by a single basis point, 434.25. Huge week for central bank decisions. Wednesday, the Federal Reserve. On Thursday, the Bank of England, right here in the City of London. Then on to Friday, it's the Bank of Japan. Live from London this morning. Good morning.
best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Equity shaping up as follows on the S&P 500, slightly higher, nudging higher by 0.1%. Likewise on the Nasdaq 100, just drifting higher by 0.15, coming off the back of a really mild week of losses on the S&P for a second consecutive week. Into the bond market, hardly talked about, but worthy of attention, a 10-year yield, very close to cycle highs, 434.25 on a 10-year right now, yields up by a single basis point. The intraday cycle high on a 10-year was back in the summer, late August, Lisa, 436.18. We're not far off, are we?
And how much is this being driven in part by the wages that we keep talking about, this concern that wage price spirals are going to keep boosting inflation, or how much is this driven by something else with budgetary reasons? Either way, it to me is underpinning the tech underperformance and a lot of the questions in markets going forward.
I'm going to go all Neil Dutta on you here from across the pond, and Neil Dutta would say it's probably a burgeoning economic recovery and a real buoyancy to it with some demand function, which just lifts up yields into maybe a higher nominal GDP than anybody imagines.
Do you want to throw crude into that as well? 94 Brent, 91 WTI?
Yeah, I mean, what part of EM? We've got Christian Mela coming up later in the week with JP Morgan. To me, that's a key interview here. He's going to reframe EM demand for oil. Granted, it's a shock to see how fast oil's moved. And this morning, I think we saw 94.74 intraday high on Brent crude. That's shocking statistics.
It's amazing to see it, Tom, this close to triple-digit crude at the same time, yields near cycle highs when we were meant to be talking about recession at the end of the year, according to the outlook at the start of the year. I want to finish on foreign exchange. 9 consecutive weeks of dollar strength against a weaker euro. The euro right now, 106.72, showing a bit of strength and positive by 0.1%. Standout decision of last week, ECB President Christine Lagarde rocking a hard place, TK, and hiking into it.
Oh, yeah, under 107 is where euro is, and we'll have to see how we do. 1 bank, 2 banks, 3 banks this week as well. But the answer is we've got resilient dollar, and Jeffrey, you made clear short term that will continue.
Dollar strength, and maybe, according to Jordan Rochester over in Nomura, we come back down to about 105. 105 on the euro. Under surveillance this morning, TK said it, key week ahead for central banks, starting with the Fed on Wednesday. Traders expecting a pause, while a rate hike from the BOE on Thursday is seen as likely. The BOJ rounding out the week with their decision coming on Friday. Out of those three, Bramo, what stands out for you? Fed, Bank of England, or BOJ?
I think it has to be the Fed and the statement of economic projections in particular. People looking at the dot plot and understanding if they upgrade financial growth
this time around.
Yeah, but do they upgrade their expectations for the economic growth in this country? And then do they just assume inflation can keep disinflating immaculately, or does that raise some serious questions about how far they have to go?
Well, you say, will they upgrade? Are they going to mark to market their forecast?
Okay, same thing.
Basically,
yes.
Because they got it wrong.
Exactly.
This economy has been so much better than people thought it would be. And based on the incoming data, Tom, we're expecting that GDP revision up, inflation down. It's 2024 that's going to catch my eye.
Yeah,
where do they see 24 going? And how much wood is there to chop? How much can you push against those rate cuts that people still expect later next year?
To your point, and Lagarde didn't go all Draghi on us and give us a lot of certitude about 2025. You're not going to get that from Powell. These guys are going to be focused on a massively data-dependent set of meetings into next year.
Pretty sure Lagarde's just desperate to get through 2023 before talking about 2024. The update on UAW, President Sean Fain rejecting a 21% pay increase from Stellantis as the strike against the three major US automakers rolls on. The offer coming in well below the 36% raise the union is seeking, with Fain calling it a, quote, no-go, signalling the union and the automakers remain far apart in negotiations. If you follow the interviews, Lisa, I do find it curious. Is it 40 or is it 36? It dropped from 40 to 36. Then in conversations I've heard in the media, he's still talking about 40.
So I don't really understand, and we don't understand what the line in the sand is and what they're pushing for. Either way, it seems like the Detroit automakers are already paying vastly more than Tesla, for example. They're paying about $66 on average versus $45 on average. And Wells Fargo estimates that if they conceded to all of the demands, that would go up to $136 per hour on average for all of their employees. So that's what we're looking at here.
The final story is just to make people living in Manhattan feel better about themselves. Britain's property market breaking another record, rents growing at the fastest pace in at least a decade, while homeowners pushed up asking prices for the first time in 4 months. Tenants paid 12% more than a year ago, according to data from Hamptons, with the average rent in the UK and Britain now £1,300 per month, the highest on record.
Give us an anecdote, John, of all your contacts, particularly in the Midlands. You know, give that I don't need the details of family and all that, but give us a John Farrell anecdote about how people are living this.
I won't share a personal anecdote, but I think we should do the compare and contrast. It is so different in the UK because of the mortgage market structure. And Lisa, you and I have talked about this a million times. If you've got a 30-year mortgage in the United States, sit on it, hold on to it. Tease people about it, bully them if you want. I don't know what happens around the dining table. That's what Bramo does to me every single time with their 2% mortgage. But you're going to hold on to it, Lisa, and you're not going to sell. Right. In the UK, that dynamic does not exist. So you're going to see that effective rate in the mortgage market in the UK come up much more higher, much more quickly than you're seeing it in the United States at the moment.
And how much does that really sort of fortify some sort of wage price spiral if people are realizing that they cannot live with the same salaries at the same levels? And so it just keeps going up, and it's just this whole kind of, you know, spiral.
So Governor Bailey's got short and fixed non-legs. Is that what we call that?
Well, Bailey's also staring down the barrel of something like 8% wage growth as well.
Yeah.
Inflation dynamics in the UK are very different. What's intriguing about the BOE decision on Thursday is that I see a lot of people are expecting a rate hike. Then I look at the recent communication from the core of the Bank of England. They're not screaming rate hike on Thursday at all. So there's a bit of a divide, I think, between the communication I'm hearing from Threadneedle Street and what the economists here in London are expecting on Thursday.
Yeah. I was having my hot brown water this morning. Kathleen called in.
Okay.
My phone rings. It's Kathleen. Kathleen says, my daughter's going to be on with you today.
Oh.
Be sure you pronounce her name right.
Are you going to pronounce it right now?
Madeleine. It's
Madeleine.
not Madeline. It's not
Madeleine.
like Bemelman's Bar or, you know. Madeline
it's not Maddie,
it's Kathleen,
it's Madeleine.
Yeah. Okay. Kathleen, thank you so much for informing me. Madeline Jones, good morning.
Thank you so much.
What John just talked about, you know, we talk about it in Cosmic, but you live the non-fixed floating rate market. If you were to speak to your mother or anybody else today, what does your world of floating rate debt at Oaktree do to the people of the United Kingdom, or for that matter, adjusting out over time in the United States?
Well, the floating rate market, so we're mainly talking about loans here, bank loans, which are supplied to single B average quality credit companies. And so these were structures that were put on back 3 years ago, maybe more than that, when floating rate was negative in Europe. And they weren't designed to contemplate the sort of rate hikes we've seen in the environment.
So when they reset, it's, to be clear here, price up and the asset value goes down.
Well, I think it's not as linear as you're making it out to be, because it comes back down to what's the structure of that balance sheet look like, and can that company tolerate that inflection of floating rate underlying rates that we've seen? Some companies can and some companies can't. I think the good news for Europe is that a lot of companies can tolerate it. They have not got debt maturities for some time, so some of them with a fixed rate market won't have to reset their debt. And also, you know, we've had 2 or 3 years of quite shocking environments, not just COVID, but also the Ukraine invasion in Europe. And so companies have been quite conservative with their balance sheets, paying down debt, not making big acquisitions, not doing shareholder buybacks and dividend payments, becoming a little bit more aware of the fact they've got rising cost of debt that they've got to deal with. So although we do believe there's a cohort in there which is structurally challenged because of the balance sheets they put on years ago, we don't think it's a huge insurmountable problem for the market.
Can we build on that a little bit more? Just the difference between the transmission mechanism in the United States and in Europe, given so much is done through the banking channel in Europe compared to, say, the United States.
Yeah.
Does that mean the speed, the magnitude of the pass-through from rate hikes into the real economy is different? How does that work?
Well, you're right. On the corporate side, more floating rate corporate debt. So the feedback to the corporate is very quick, but the transmission mechanism